Most people think that the first casualty of war is truth. They're wrong. The first casualty of war is clarity. When the first shots were fired in Iran, the world's attention turned to maps and troop movement. While the world was watching the headlines, the master ledger was already shifting beneath our feet. Before we go a step further into the fog, I need you to do one thing. Hit the subscribe button and turn on your notifications. We are entering a period of profound uncertainty, and this podcast is your home for the data that the news cycle misses. If you value this level of transparency, hit that like button now. It's how we ensure the Main Street perspective reaches the people who need it most. Welcome to the official launch of the Main Street Briefing Economic Fog, a new reoccurring series here on the Main Street Meets Wall Street podcast. This isn't just a one-off update. This is a comprehensive compilation that will serve as a definitive economic record of this conflict. Be a part of it. We began this journey today, and we will continue to release these briefings monthly for the entire duration of the war. We are looking at the invisible gears of private credit, the systematic collapse of trade models, and the reality of your portfolio in a fractured world. Our community at the Wall Street South Journal on LinkedIn has already cleared 1,300 subscribers in less than 2 months because people are hungry for this depth. Today, we aren't giving you a summary. We're going into a multi-hour deep dive into the mechanics of the outbreak. To get you caught up, we're dropping our most critical briefings all within this 1 week. Today, we're focusing on February, where we talk about, and it's a rare 3-part time capsule that documents the world as it changed. The first one was recorded 1 week before the conflict, when the risks were still theoretical. The second one was recorded just 24 hours before the first shots were fired, the final calm ledger. And we aren't stopping there. We're also conducting one of these briefings with a kitchen table segment from Policy for the Normal People, focusing on the domestic tools that you need right now. Settle in, grab a notebook, tell a friend, and let's get into this briefing. Oh, another note, these sessions were all live. What's up, LinkedIn, Riverside, YouTube, everyone streaming? Friday, markets just closed. And about to sit down with Mr. Stephen Davenport, CFA. We're going to have a conversation just recapping the markets and what everyone's seen. This is live, so if anyone wants to chime in, ask some questions, knock yourself out. It's a little more laid back today. But yeah, I think we should probably just, let me begin by saying how you doing today, Mr. Stephen?
It's kind of rainy here in North Carolina, but it's a hell of a lot better than snow up north. And I'm just trying to figure out if spring is coming or if we're going to have one more batch of cold. What do you think? Do you follow Punxsutawney Phil, or who do you look to for telling you whether it's going to be a nice spring or whether we got 6 more weeks of winter?
I'm in North Carolina, so I know that we can have spring in one day and winter all in the same day. You just never know. There will be some colder days. So yeah, this weather is crazy, Mr. Stephen. It's crazy. You know what else is crazy? These markets, right?
Yeah, I can't believe after that State of the Union, I don't know, there was a lot to unpack there, Marcus, but these markets are seeing things coming in all directions. And I honestly have never seen this kind of things that it worries about, things that it doesn't worry about. And it's becoming very difficult. I see more and more people who are getting on the gold bandwagon, and I see more people just not sure about where are rates going? I mean, we could talk about different things, but I just think there's a whole lot of uncertainty.
Right. And we'll get to the rates for sure. I mean, because yeah, after this morning's PPI came in and shocked the markets. Well, I don't know if that's what shocked the markets. The markets are already, these markets have been so unsteady. There's been a conflagration of things. So let's start with maybe private credit.
Okay. I think that over the summer we had a few instances where some of those auto companies we had assets double pledged. But this week we have a British company that went under and they found out that their assets were double pledged. So I think the total losses is somewhere around $1 billion, and Apollo is a part of it, Jeffrey's a part of it, and a little bit of Wells and some others. So when I look at private credit and I see a comment by Jamie Dimon about cockroaches, when you see one, you see many. That kind of makes me a little bit concerned. I don't like to see cockroaches in my house, but I especially don't like to see them in my investment portfolio, especially now that you get closer to retirement. Something like that could upset some of your names and some of your positions at a time when you really need them. And so I just look at what's happening and I say, if Jamie Dimon thinks there's cockroaches that haven't been found yet, who am I? I mean, he's got more people and more insights with the lending book, with the savings book, with the, just all the deal making globally. I don't know if I'd say he's the most informed, but he's a pretty informed investor. And so when I look around, I try to figure out who are the informed investors, and then I listen a little more closely to what they have to say. Who do you listen to really trust when you want to know what's going on in the market, Marcus?
So my approach to who I listen,
Besides me, I
well,
mean,
yeah,
I know I'm probably first on your list, but after me, who else?
besides what you send me in Adam Park, after y'all send me all your fancy research. No, I like to obviously look things up myself, but as far as like, there's not one particular person. I know like Jamie Dimon, he's very bearish. I like to listen to everyone that I can, but people who have insights, I like to hear Brian Moynihan from Bank of America. He has a really good insight into the consumer. So into main, they really see behind the scenes with consumers, like how consumers are spending. They'll have a lot of reports that come out. So you'll get a consumer sentiment report, say from University of Michigan, where sentiment is really low. And then Bank of America is actually like credit card data and consumer spending is higher. So it shows the divergence. So I just find that fascinating what people say versus what they're doing. So, and Jamie Dimon, like I said, he's pretty much bearish all the time. It seems like he's always worried about stuff. But when you manage that much money and that type of bank, it's one of the largest in the world. So that you would be nervous all the time. So yeah, I don't particularly listen to one person.
I like to think of it as healthy skepticism, Marcus.
Yeah, he's very skeptic. But yeah, I mean, and like you said, he sees a lot of things other people didn't see. He made that cockroach statement when that was last fall or winter.
No, he made it recently in the last week or so.
He made a cockroach statement like last year too about
Yes,
cockroaches.
he did.
And then you saw
This is not his first cockroach.
right.
No, this is not his first cockroach, and it's not going to be his last.
Right. And just like cockroaches, you're starting to see things come out. Like you mentioned the bank over there in England. I think it was like $2 billion or something that they lost in funds.
Right.
So that's just, and so another thing, and we're still in this private credit, like think about, and these are the cockroaches that we're seeing, the things that are coming out right now. But think about the things imagine if we did not have the regulations that we had after 2008. Like this will be hitting the mainstream banks. Do you think this is just a ripple effect that eventually will hit the large money financial centers?
I think that, there's a lot of people that have said that the banks have become cleaner because they didn't engage in a lot of these private company, and they said there was basically the shadow banking that was going on where a lot of these things were being spread out to high net worth investors. I think that when you look at it, private credit right now is over 2 trillion. And during 2008, it was about 1/5 the size, or about 400 billion. So private credit's gone up in the last 12, 15 years because I think the banks have tried to isolate themselves from and keep themselves in spaces where they think they have a better chance. I think that for individuals in this space, you really have to know who is doing the evaluation and what is the space you're in. I've got a private credit investment and it's apartment rentals. And I believe that, the research that we've done and the properties that we're in are good properties. So I don't think it's a problem. But I can see that some of these companies that are double counting assets and leveraging against, 2 or 3 times against the same asset, that's a problem. Just like we saw in 2008, there were banks and people, that were using the same assets and having lending agreements between multiple parties. It's not it's not a unique concept, but the whole idea was the Fed was going to take a more holistic view, and therefore these things are outside the purview of the Fed. So therefore, they don't have that type of protection because we don't know who some of these shadow lenders are. We're not going to see who they might be collateralized with, multiple times. So it's another part of the market, Marcus, that I think has to put you have to put a profit size on something like that. Should you be in private credit? Maybe. Should you be 20% in private credit, 30% in private credit? I don't think so because liquidity matters, right? When you want to put things in safer assets, you want to be able to get it. And once you go into these, it can take you 5 years to get back out of. So that's not really what I would call liquidity that you can use if you're looking to respond to an opportunity or do something with your assets. I think it's really important that we think about liquidity first. If the markets were to go down 30%, what would you buy? Wouldn't there be some things that pop up on your screen and say, hey, this looks pretty good now? And then the question is, how do you finance it? Do you finance it from cash? Well, if you keep too big a cash position, you're going to probably have a problem because you're not earning anything on that cash. I think that this issue of liquidity is what's showing up in private credit. And I think the same thing, is starting to happen with some of these startups in the AI space, in the quantum space. Do they have the liquidity to last through a period of downturn and slowdowns to come out the other side complete or even better enhanced by what they do? I think that's why we all keep a certain amount of safety so that those safe assets can fund our risky assets in times of trouble. And I think it's a part of everyone's, Buffett used to say, you don't know who's wearing a bathing suit until the tide goes out. Well, the tide's starting to go out, and we're starting to see some people that might not have, the right Speedo on.
Got you. Yeah. And so great explanation. Going back to the private credit and how the rise of private credit, just the levels that you mentioned. And like you said, 12, 15 years. So like right after 2012, right around the housing crash, these regulations were implemented and people found ways to go. They had to go to private credit, some of them, because they were getting larger returns. Some portfolio managers said, if I'm trying to beat the market, the only way I can do this is if I have a portion of private credit inside of my portfolio. But as you mentioned, also, you have the liquidity problem or illiquidity problem, I should say, where everything's locked up in there and you can't get your money out. Or just like, right, what we see last week was that Blue Owl. So in Blue Owl situation, where you have a company that's locking up their funds, but they also pay some of the fund holders. What were your thoughts on that, Blue Owl?
I mean, I think that Blue Owl, I think that, we're seeing, Ares and Blackstone. Some of these parties just we've always heard from people, look, if you want to invest in private equity, but you don't want to take all the risk, own the companies that run the private equity. And that's been a strategy for people. And I guess I would say, just as those companies can have good investments and bad investments, you have to really know those companies well to see whether they're in spaces that you feel comfortable with. And like most things, Marcus, you're going to have to endure a little downside. And I think that, look, we've had 3 years of almost 20% returns, right? So what does that tell you? If the average return of the market is 8 to 10 and you have, triple that times 3, I think we're saying the markets have given a great deal in the last 3 years. Would today be, or this year be natural for it to slow down? I think it would. Would the private credit demand slow down be normal? Absolutely. These things come and go, and we've got to be able to deal with it in a way that's not going to change our lifestyle or change our ultimate wealth outlook.
Okay. So inside of private credit, you have private credit is supposed to be a diversifier inside your portfolio, right? So when the market goes down, it should, in theory, go up, right? It should work when the other part of your portfolio doesn't work. But the problem is or one of the issues, I guess, inside private credit is some of these S&P companies that we mentioned are tied up inside this private credit. They're going to find financing inside this private credit. They're going to find things to get better returns because they have portfolios that they have to, or returns they have to reach as well. And they have such large budgets and balance sheets inside that. A good way to think about the the lockup. I don't know if for folks who've seen The Big Short, there's a part where he just calls his investors. He might send an email and just tell them like, you can't get your money out for like X amount of years. You know, talking about like I just picture like that's what I picture in Blue Owl when they came out last week, or just or week before. Like, are they just sending out emails just like?
Yeah, I think that you have to expect the unexpected when you're in these spaces. The other thing that's a little misleading, and this might be too technical, Marcus, so tell me to stop if I am.
No, go
But
deeper.
these things are priced by a pricing source, not the market, right? So they go and they hire a firm, and the firm comes every quarter and gives them a mark and says, okay, now these investments are worth $10 million. And you look at that mark and you say, is that really what these are worth today? Or is that a positive number because they're being paid to deliver a number to this firm on how much these assets are worth? And so when you price an item every quarter, it's not the same as the market that trades every day. And so the numbers that you get for these private equity always look better. The reason they look better is because they don't have much instability in between the pricing at the end of September and the end of December. They are able to smooth out those returns and make them less volatile. And by smoothing them out, you take that 17% return that might be the same as the stock market, but it's got a volatility that's half of that. So what do? You say, oh, this is delivering more returns per unit of volatility. But in reality, it's just not being priced the same. And so how you price things and how you account for the values determines a lot. And I think that when we look at these things, we have to take an educated view and say, I understand that these are different, but is the difference in the methodology significant? And I think it is. And so that's why we have to be extra careful when we think about them, because they're not the same as that company that's reporting publicly every quarter and every day when the market opens, their share. And that's what Blue Owl will be saying, right? I mean, that one day when they announced this, they're down 6.5%. A lot of value in a company disappears quickly, right? I mean, we could talk about private credit, but what about NVIDIA this week? They report blowout earnings. They kill it in revenue. They kill it in forecast. But people start to question, how long can these earnings and these margins be this good? How long can private equity deliver extra return? I think that that's a healthy question to ask. And as you saw this week, even the best earnings of NVIDIA weren't enough for this market. So that tells you the market's becoming less receptive to the same stories that we've heard before. And if the story changes, if everybody goes to a different side of the boat, you don't want to be left all alone on the wrong side of the boat, right?
Right. And coming into the year, everyone was on one side of the boat, uber bullish. Just like last year, coming in, people were kind of bearish, and the opposite happened both times. Got off kind of rocking the start last year, 2025. Then we got into the tariff and economic detox. We saw some turmoil, and then took off again later on around April. Going back to when you were mentioning those marks and the rating agencies, that's what you're referring to, right? Rating agencies when you're talking about the marks?
Or the people that do the pricing for the different marks on the different securities. They're consultants. There are different people that will estimate the value of some of these non-public private assets.
Right. So one of the things, Stan, I guess just thinking with The Big Short, because that was private credit that he was using, those structured notes. Like people couldn't just buy those. There's a part where they go to the rating agencies. Do you recall what I'm talking about? They go to different ones and they're like, truth is, if I don't give them this rating, they can just walk right across the street. And for those who haven't heard all the, I did a podcast with James Callahan, who worked in debt and credit ratings. And man, it's fascinating. But we talked about this stuff, like how to go deeper in there. That's an earlier episode in a podcast. But how do you think those things are stopped now? Like what would stop someone from going in there now and just saying, let me give you this good rating because, I mean, they're getting audited.
Right. I think that, look, The Big Short is a good example of how that market for mortgage securities was different. I think this time it's going to be different. It's not going to be mortgage securities.
No.
It's going to probably be some of these private credit securities. It's going to be some of these SPACs. It's going to be some of these entities that have been created, with leverage. I don't think that when you add leverage, people understand it helps on the upside, but it hurts just as much on the downside. I mean, I think what happened this week that was more interesting is what happened with AI. AI just seems to, there was a research piece out by a group called Citrini Research. And Citrini Research wrote a letter to themselves in 2028 and said, what's happened since 2025? And the letter outlined what's going on and what they see in the marketplace and how the idea of efficiencies coming from software and software being developed by AI ended up causing a very long cycle downturn where they basically said less software people, more margins in the company, but less software people means that more people are on unemployment, more people are out of work, the overall economy slows down. And they just laid out a pretty gruesome look on the research piece came out Sunday, and the market started absorbing it Monday and Tuesday, and it just started to go ugly. And then today I see when you look at companies like Block that are doing taxes, they announced they're going to lay off half of their workforce because AI has replaced some of the need for those people. 4,000 people. So when you go into tax season and they're taking half of their workforce away, that tells you they're making a pretty strong bet that AI is going to deliver, and they're going to deliver in ways that are going to allow this company to be much more profitable. Will it happen? Will there be difficulties? Will people start to trust AI with their taxes? It's all too early to tell, Marcus, but that company's making a pretty strong statement when we say, is it possible that jobs could be replaced that easily by software, and that software would continue to be developed by AI, not by people? And so basically you have a software that's creating more and more efficiencies, and it's really frightened a lot of the people in the ServiceNow and some of the names that are involved in software development. So is AI going to eat up software? I don't think it can, but one of the things that was leading it this week is this company came out with a version that can update COBOL. So COBOL still exists in a lot of firms. It's an old programming language that I took when I was a computer major in the 80s. And basically, they're saying we can update any COBOL code to current code just using Claude. So that's how many software developers are out there trying to maintain code in these old softwares that would be replaced. It's a frightening to think that all of that COBOL code gets updated, and then all of a sudden it gets maintained and managed going forward through Claude or through someone of these other AI agents. So what's happening with the news is starting to lay out a future, and we're not certain about that future. We don't have, the idea of an economic payment that the government would give to people who aren't working. They've talked about, how do you feel about all these taxi drivers and people that are going to be replaced when Uber has driverless taxis? It's going to be a huge number of individuals who are going to lose jobs, and there's just not going to be that many easy jobs to get going forward. So I look at what's happening with the COBOL code, I look at what's happening with the driverless vehicles, and I think that we haven't thought about all the things we need to put around AI so that it doesn't cause the markets to stop and crater and just create an environment where nobody believes anybody's going to have the revenues to keep the economy going. We're a 70% consumption economy. What level of unemployment would cause us to suddenly have I can just tell you, 50% of the workforce at Block, that's a frightening number, especially in your first year of using it. Wouldn't you take, even if you could get rid of 50, wouldn't you keep a buffer just so that if you could try to make sure it doesn't get carried away?
Yeah, that was a lot. You said you're going to go down that hole, and you did, and that's great. With Block, we'll try to go back and bring it forward. Block, you have the guy who used to own X, right? Twitter. He's known for having a heavy staff. So at a certain point, when Elon Musk went into Twitter, he took out, or X, sorry, politically incorrect, whatever I'm saying. He took down, reduced, or so he said, 75% of the workforce in there. I know part of that was bloating by Dorsey, but part of that also was probably Elon Musk cutting a little bit more than he should have in the effort to get down. But so I think Block cut like
40%, which is a crazy number, right? Because if you extrapolate that out and companies start cutting 40% of their workforce, that's the kind of stuff that would throw this country into a recession, right? Like, there's no doubt if like people start losing 40% of the workforce, like it'll be bad, and it'll be bad soon. Like interest rates, prices, people can fight with these prices when we have jobs to earn money. Even if we're losing purchasing power, we can last a little bit longer. But when we lose jobs, that's the thing that tilts it. That's why maybe you're seeing the bond market move today. Notice the bond market finally went below 4%, which is just like, whoa. One more note on because it hasn't been there in a long time. It's been like hovering in this range, just like unemployment. You mentioned unemployment. Unemployment's been hovering, 4.5%, somewhere in that range. But last year, I keep going back to last year, and this might even have been like late 2024, those forces, CRM, Benioff, he was on a station saying that he expected AI to replace all his agents. Like he was going to use all his agents. So when they say things like, and then we see these things later, like I think people are just at a point where they want to see AI. They want to see the production from AI, right? Like they're getting fatigued, like you mentioned with NVIDIA, where it's range bound and stuck. But was Block up today?
I didn't look into Block. I just looked at the press release, and I know Dorsey is a big player in this space, and I think he wants. I don't want to keep going all over. OpenAI, valued at $790 billion today. They took in $110 billion
From Amazon.
I thought OpenAI was going to be a larger company, but I guess I'm late on the valuation here. But taking in 110 billion now today in an offering, to me says they're striking while the market is still pretty hot, right? Would you say that AI has gone back to normal and the market valuations are average again? I don't think so, and I think that them getting a valuation like that, almost $1 trillion company that's not public. I mean, that's I don't know if you call it a unicorn or you call it a super unicorn, or you know what I mean. It's I'm losing track of these companies that are so large and still not public. And I think you have to wonder, hey, why aren't they? Why don't they want to come public in the market? And then you see, companies able to do more and postpone eventually having a day-to-day measure. And I think it's nice for them if you can operate there. I don't feel like, I don't know. How do you feel about AI, OpenAI? Would you invest in that?
OpenAI and Anthropic, those type of companies? I actually think I am. So I have a REIT too that I invest in, like Fundrise. Full disclosure, I got to put that stuff out there, right? And they actually just bought SpaceX or OpenAI or something like that. But all that private credit stuff, my approach to that type of things, like you said, this is pre-market. And will I buy it when it goes public? Probably, but not at the IPO. But eventually, probably not the IPO because it'll be overinflated, but it'll come down at some price. There'll be because what they're doing is like groundbreaking and revolutionary. I think we said this. So for those who don't know, me and Mr. Stephen, we're on an advisory board together for his company, and we were talking about AI. And this was a couple weeks ago. And now I mentioned like there are going to be companies that just aren't going to make it, right? That we see right now, like big companies, big names that we see right now. And I'm not trying to pick one or say one, but there will be companies that we speak of right now that are spending a lot of money in CapEx that just won't make it. They just won't be there anymore. Like think back to the .com bubble, right? How many companies did you see, Mr. Stephen, that back then that aren't here now? Because that's what people want to try to compare this bubble with and this
Yeah, I mean, the pet one was a big one. There's a lot of companies that were based in that time on eyeballs, and that was how they measured it. How many views do they have on their sites? And they thought, hey, we convert those views at a 1 in 100. Therefore, if we get 1 million views, we could say that we're going to have this much business. It doesn't always work that way. And I think that here we're looking at a different variable, which is how much can I improve my margins? How much can I reduce overhead so that my corporation can compete with other AI generated corporation and products? And I think that we don't know the speed, we don't know the overall demand, and we don't really know, like as this Citrini article said, we don't know if all of a sudden this loop stops and we start to say, maybe we shouldn't be taking all the humans out of these corporations and we should keep them in such a position that they're not just causing the workforce to be decimated. I think we're going to have to deal with the workforce in terms of taxis and what's currently done with truck drivers. Those type of driverless technologies and how we deal with them, I think are going to be a big indicator as to how AI and ultimately the whole economy deals with a transformation. What are these people going to do? How are they going to be retrained? How do we create a situation where they can be out of work, but the economy isn't cascading downward so that they don't have any opportunities to get back up? And I think that when we look at us as an economy, we all talk about, hey, the market's going up. We're all happy. Remember, only 50% of the population owns stocks. 50% does not. So when we say the market is good, therefore the economy is good, it's good for a part of the population, not the whole population. So I think that when we look at these things, we need to put them in perspective. And I think that the Fed has this dual mandate, and I think they're going to be there's going to be a little bit of a problem with how do I still see inflation and how do I then also see the need to cut rates? It's a conundrum, and I don't think it's going to be easily solved in the short term. Because look, I don't know how the change in direction for tariffs from Trump is going to move things. I mean, I think if I go to the next topic, Iran, how is Iran going to move markets? Is there going to be an event? Is there going to be an overthrow, or is the religious government going to be removed by force? Is the U.S. going to be doing it, or is it going to be a joint effort with multiple countries? I understand Iran has a history and a great culture, and I understand that there are people who want change. But as I said, Marcus, how much change are we good for? If we have AI redoing the workforce and we have people in capital markets and investments that are going in a direction, can we absorb Middle East conflict just like it would in a time of what I'll call more normal markets? I have a feeling we're reaching a little bit of a breaking point. I just see that a deal is within reach with Iran. Just came across my screen.
Really?
What do you think of that? I mean, would the markets react positively to that?
I mean, where's the reporting, right? I mean, I guess it depends. Oil prices should go down. They've been up. The market should react positively to that, man. If there is really a deal, I mean, there was tensions. That's one last thing off the market's plate right now. The market has so much on the table. The market wants clarity, right? The market doesn't like all these different things going on. So the threat of us going into Iran and doing whatever we were going to do in there, I don't know what the full plans were. That was going to disrupt the markets. As you saw, I mean, we've seen it. The market just had so many things going on. We've had the SaaS sell-off. We've had the private credit issues. We've had the actual data that's come out, like you were mentioning earlier. Where are we at with the rate cuts? Where are we going to be with that? Like Powell's probably going to have to hold steady. We have Warsh coming in. And then, yeah, like you said, breaking across the tape right now is Iran. So I don't know. Maybe I'll look and see what it did after hours.
Yeah, I mean, I think that Iran is under a lot of pressure. I think that we've got pressure in Cuba with that regime. They're not getting supplied oil from Venezuela anymore. I think that these areas where we don't agree with, or we don't support some of these governments that we think are doing bad things for the people, and then we can transform some of them, but can we really institute long-term change? I think we can say, is Venezuela better without Maduro? Perhaps, but if his assistant, executive vice president becomes the president and all the same people stay in place, have we really changed Venezuela? I don't know if we have.
Well,
And I think the same things.
I was going to say, I think the world remembers, or the U.S. remembers, when we went into Iraq and eventually got Saddam Hussein, like that country just was in turmoil, that the internal systems weren't there. So that's probably a big part of it too.
Yep. So I guess I would say, Marcus, the same things that I recommend when markets are calm is you always need to have some safety assets that you can take advantage of a downturn if it occurs. And I think that some people look at bonds and say they're not useful. They're not giving me the same returns I need from equities. I want to have the higher growth asset. And my point is that you got to assume that the market has an up period and a down period. And you've got to build a portfolio that can sustain itself in both cases. And that's really what I think. People have had 3 years of positive returns. And so now I think they're looking more closely at where is the next, blind spot? Where is there something that I can't control? And what do I need to do to make sure I'm safe? And I think that it's healthy. I know we make fun of skepticism, and you're a more upbeat guy, and I'm a more skeptical guy. I think there's room for both of us in the markets because I think that in general, it's good to have dialogue. What I saw recently was worrying a lot of people is there aren't people who are willing to step up and be skeptical about AI. Is that healthy? I don't think it is, because you really, any idea, any change in technology, any new process is going to involve change, and that change just needs to be kind of verified and understood by even guys like me. You know what I mean? If we can convince the economy that it can operate in a new mode, a new challenge, a new way, I think it can be accepted by people. And right now, I guess I don't see the support around some of these AI technologies that creates, an environment where they could streamline a company, and the people who would be streamlined or eliminated could have other opportunities to participate. Do you think that AI is, in a position to make the changes that it talks about, or do you think we'll see with Block in the next 6 months during tax season?
Okay, yeah. So I use AI, right? I use AI for a good bit of things, like just I use it for editing videos. I use Riverside. But as far as I think a good use for AI would be if we are going to have wars, hot wars. I know a lot of them are fought from distances. Why don't we have like some AI robot soldiers that we can send in there and keep these troops out, like actual combat? For one thing, I know we use drones and things like that, but where are we going to get that later? Let me see those type of AI use cases, right? I think that AI we spoke about before, you have to adjust and adapt to AI because AI is coming to take over. I say this like tongue in cheek and jokingly, like AI scrubbed all the internet. I think we mentioned on the podcast we were on together how AI has its own like social network now where it's just AI bots. I'm convinced that AI is just like waiting for Arnold Schwarzenegger, to leave here because they've watched Terminator and they know he's like the only one who can stop them because that's what they've derived from it. Like, so, I just don't know with AI, but I do think AI is going to destroy some jobs, it'll disrupt some jobs, and it'll definitely create some jobs. Which one is it going to do more of, right? I want to ask.
Well, that's the thing. I saw a demo today of robots in China. They have a Chinese robotic company that was showing off the robots, and they were doing handstands. They were doing, all of these different things. When you think about a robot, think of kind of minimal movement, and now the technology and the way they've developed them, they're multi-hinge, multi-directional, just forces that can do a lot of things. And I think that we've got 4 or 5 bridges to go over in my world. We need to get over the driverless car. We need to get through, using robotics to replace some of the factories and some of the labor that is hard to do because it requires, environmental damage and other things. So you can't have people doing it. I look at these chip fabs and I wonder how much of the chip fab is going to go towards robotics because, do the people or the robot deliver better technology, better ability to make decisions and do things with chip fab. So I think there's a lot of things to come. And I guess I would say I need to understand better how the process is going to go. And I'll be looking very closely at, at what I'm seeing with the taxes and Block.
Yeah, so you're watching Block. I mean, it's almost like, I don't want to say you were short Block, but you definitely have some skepticism around Block right now from a skeptic.
No, I liked Block. I used Block for years myself. And now I have a person who does my taxes. And I used to, I did them until 2 years ago. So I used to be a big H&R Block fan. So I think of it as having a huge advantage. And what they're doing, I think, is going to be interesting. I mean, the last thing I had to talk about today regarding this market and what's happening is midterms. I look at what's happening in the Senate and the House and the number of people retiring. And this election in November is really going to be a referendum on Trump. And is it going to be a referendum that says, yes, we're happy? There's a lot of people arguing about affordability. And if affordability doesn't come down, especially in housing, I see there's going to be a problem come November for Trump. Do we really think inflation has been slayed? And if so, we think the Fed is going to lower 2-3 times before October and create a better market for housing. I'm not sure. I think that that's one of the main issues and why he put Warsh in as the new chairman of the Fed was to deliver lower rates. I'm not sure whether some of these things are inflationary. If we go to a new set of tariffs, even at just 10 or 15%, if they're more stable and if they're easier to implement, it's going to cause higher prices. And those higher prices are going to come through as inflation. And I think we can say they're temporary inflation because of tariffs. And once people get used to them, maybe they'll stop. But I really don't know, Marcus. I mean, as an issue, I think it comes down to what's going to happen and what will it look like in October and November of this year. I think that the bell's been rung, the State of the Union's been had, and I think that both parties are going to work like hell in the next 6 months to deliver on what their vision is. I don't know if any vision is really able to capture everything that's going on right now with ICE, with AI, with Iran, with, we still have actions and finances, subsidizing Ukraine. It feels like we've got a lot on our plate, and that's not saying anything about Taiwan and China, which I still think are a factor. Should we, if the election were held today, what do you think the referendum would be?
Well, Americans and people in general vote with their wallets, right? Like we say what you want, but when prices get too high and people can't afford things, inflation is crazy. People vote with their wallets. I'm glad you brought up the midterms, and we'll definitely dig into the State of the Union a little bit as well. But with the midterms, that's also a thing where the markets tend to have choppier years in midterm years. So historically, you'll see a little bit of chop in midterm years. So we can see that right now, but in the second half of the year, once you get a little bit of clarity, usually after elections, you can expect to see a bump or a rise in some of these stocks. Also, with the midterms, and right now, like I said, we're speaking about people paying with their wallets. So we've noticed this movement out of stocks. I think maybe another thing that we're seeing are people are finally getting to the point with affordability where they're having to sell some of their stocks to pay for things as well, too, right? Because you have this paper wealth, but it's not a gain or a loss until you actually sell it. So people are sitting here, or maybe they've been pledging them against things, pledge back their securities and using them more, but now they're just actually at the point where they have to sell them and they're paying taxes or they're looking for big refunds. It's very interesting. One of the things that jumped out to me inside of the State of the Union was when President Trump mentioned that he was going to create an account to match 401ks for adults, right? $1,000 match. Like, I didn't run the math on that, but that's crazy math. And
well, I think he's only doing it in places that it doesn't exist.
That doesn't have the match, right? That's what he said.
It doesn't have a 401k, and there's no, and so I think that when you isolate that part of it, I think you're talking about somewhere in the order of 60 to 90 million. I don't think you're talking about, I think you're talking about 20 or 30%.
Did you say hundreds of millions? I'm sorry, I didn't hear the number.
I think you're talking about, if the U.S. economy has 360 million people, I think you're talking about a working population of 160 million. I think you're talking about 10, 20, 30%, which would be 15 to 45 million.
Yeah,
so yes.
Well, that's economically feasible.
15 to 45 billion if you take the $1,000.
There you go.
Yeah, if you take the million and say you're going to get $1,000 to each of those people. Look, I think when you're on the stage and you're talking about the future, we all want, I want to look good. You want to look good. We all want to sound good with our future analysis. We don't want to sound like what we're saying is anything but going to be great for the population at Wild, overall, right? And I think that State of the Unions are kind of that wish list. And so we've heard the wish list, and it could be great for some of those people. I think that the space of people and retirement assets, we haven't done enough for people. We haven't done enough if we've not created national 401ks until 2025-26. In the 70s and 80s, we knew that this was going to be a problem when people stopped getting pensions. Yet we have all of these people who don't have an access to funds. And I think that retirement is one of the biggest expenses that you need to plan for. So how we do things now, I think it's like we deserve to give these people more attention and we deserve to stabilize Social Security.
Well,
we keep talking about Social Security, but we're not really answering the question about how it's going to become more solvent.
Okay. Hold on, Mr. Stephen. So you said Right. And pensions, it was proven like mathematically these pensions weren't working for these companies. That's why they stopped doing them, right? I mean, there's still some places where you get pensions. But so you said like late 70s, early 80s, and I agree, like people need to have some type of retirement set up for them when they retire, like better than just Social Security. But it's funny because the people that set this up are the people who are now at the age to receive these benefits, right? People in the 80s, 20s, 30s, now they're 60s, 70s. So they're in the mix of it. They didn't, this is like a pure American problem. What we do, we just kick it down the road. We kick this budget and debt and everything down the road, and then we try to solve it again. So is this going to be something like that my kids are going to take care of now? I mean, it's just, and I'm being rhetorical with that question for anyone, you know, and anyone who's listening, please feel free to put some questions in the chat. Me and Miss She will love to answer it. But yeah, what are your thoughts on that?
Yeah, I'm not going to worry. I'm 62, and when they change the age from 67 to 69 or 70 for people to get full retirement, it will be retroactive to only people who are 50 and below. It won't affect people within 10 to 15 years of retirement. So when you think about that, it's a little bit more comforting. I mean, you probably will have a higher retirement age because you're like, what, 22, 23 years old?
Yeah, time something.
It's and so I don't think it's funny, but I also think that, like you say, we've been kicking the can and now we need to do something. I think it would be great if we said, hey, any new tax increases go to the deficit. I mean, make some statements with our planning and our future that just start to address things. I don't think you're going to solve things. We're a country of gradualism. We gradually went from doing things wrong in many senses to trying to improve things. And overall, the gradualism will be effective in something like Social Security if you do it soon enough. But if we don't do something about the debt sooner, it's likely to cause an upset. And I was waiting after what happened with the Supreme Court rejection last week for somebody to say, what if we had to give back the $170 billion we collected? The government's got to take that out of its account and give it to individuals and companies. And then you say, okay, where are we going to get that $170 billion for the next 10 years in the government's assumptions for the one big beautiful bill? That's 1 point. Where are we going to find that 1.7 trillion? And that's where I think this market with higher debt is more susceptible to a reaction that we don't want to have.
Okay, hold on, Mr. Stephen. I have a theory on that with the debt or the tariff refunds. First of all, I don't think any tariff refunds are going to go back out during the Trump administration. He's already said that they're going to take this to litigation, and the Supreme Court really dropped the ball by not ruling on how you put this back, how you refund this money and kicking that back down to an appellate court. But I also think like if there ever is money like refunded, that it'll just be like a debit back on the sheet. But who does it go to, right? Is it going back to the country, or are we going to get Trump checks because everything has? Are we going to get, you know what I mean? Are we going to get stimulus back into the economy? I heard someone say everyone should just get one day free in America where they can go shop and buy whatever they want for free. Like, I mean, but seriously, like, what do we do to get it back in? But I don't see the administration ever just giving it back. Not to the countries. No.
I could see, when I hear about them giving soldiers a military bonus of $1,000 for every soldier in America. I mean, Republicans want to get reelected. They have a voting block, and if you do things to stabilize that voting block and make them incented to show up, well, they gave us $1,000 refund check for our service to our country. All police, fire, all workers who are central to the operation of the country, you can do that. We had the refunds and the stimulus checks during COVID, helped the economy get started. Eventually, you start to look at these things and say, these are all just vehicles to get people to feel good about their government. And if I could give each of my kids $1,000, would I be more popular or less popular? I mean, if I wrote those checks and gave them out, I think I'd probably be more popular. I mean, it's really simple. We're supposed to be doing things with what we have, not taking money from the future and giving it to people today. It's a one-time thing. It's not. I agree that we should cherish and reward our people in action. I think we should do it all the time, though, not for a one-time action, but let's set up something that makes sure that we have the best forces and the best people. I think one-time $1,000 checks are just, it's just kind of like
Placebo.
a ribbon on your, I think it's a nice gesture, but gestures don't make, a country strong for the future. Gestures make people feel good temporarily so that they'll vote a certain way. I don't think that's what we need right now. I think what we need is more of a long-term commitment to the education, to the health, and to the wellness of the overall community.
Yeah, and you speak about stimulus and bonuses, and if I remember correctly, I'm like thinking back. I'm old enough to remember, like, one, I'm old enough to remember when a budget was balanced. I think that was Clinton. Two, I'm old enough to remember, I think, like, Obama, first Bush, Obama, Trump, and Biden all sent some sort of stimulus into the economy, right? Then they all sent us a check at some point. Maybe not,
I think
but I'm sure, especially with COVID, like, didn't Trump send one and Biden send one? I don't know. My wife just those things. I don't even look at them.
there was two or three checks, and I think at some point you realize that this is really important for one part. I mean, Marcus, the thing that we didn't really solve with COVID was who would it really affect, and who do we really trying to help? Right? There was people who were less healthy, who were overweight and had other health complications. They were most in danger. But as a country, we didn't decide to try to help them. We said everyone needs to lock down. Did everyone need to lock down? Even the people that were extremely healthy and well, I don't know. I think we don't want to segregate our country into the haves and the have-nots. And in that case, we just said everybody gets a stimulus check, everybody stays in lockdown, everybody needs to get a vaccine. And it's nice to think that, we're going to be so democratic to everyone. But in reality, we had ways that we could have done things more efficiently. And if we did it again, I think that most people would have said some type of, evaluation on different people would have probably allowed an economy to run at 50, 60% instead of shutting down completely.
Yeah, and we all know hindsight's 2020, right? And maybe Chairman Powell actually got it right when he said that some of this inflation was transitory, but he just really mistimed it, and then there are ways of pulling it down. Because these stimulus checks, that's kind of what we're feeling right now. People don't realize this inflation's all still coming from that money that was pumped into the system. And like I said, that's when you saw stock market starting to go up. Maybe people are starting to pull that money back out. The country was at record levels of savings. Like you said, we turned into a consumption economy, which is another difference in between like our last revolution, industrial revolution, I guess, which created different types of jobs. We were a different type of economy then, right? So how does AI play into this consumer-driven economy? Once again,
I think it's like what happened with the computer. When the computer came, and the computers became no longer tied to mainframes, but individual computers, it was transformation. It allowed a companies to have computer resources that never had them before because they couldn't afford a mainframe. And now we've got in your pocket what would have been a mainframe in the 60s, right? You have technology and power that no one else would have had. I think that the transformation of that technology and power is now moving to the clouds, where there will be AI agents who will help us do things. I think it's gone from our phone to the cloud, and now we've got to figure out those things in the cloud. How do they help businesses run better? But I don't know. Are we trying to get to 5, or what? Is there any questions out there, or anything you think we should talk about before we wrap up?
I don't know. Does anyone have any questions? I don't see any questions in the chat, but maybe I'm not in the
All
chat.
right.
Yeah, there's always plenty to talk about, Mr. Stephen. Let me see what else we had on here today that we wanted to chop it up about a little bit. I mean, you mentioned NVIDIA and the AI. I mean, let's just talk about so today, what are you seeing when you're talking to your clients? Are they worried about stuff? What are they worried about?
I would say that people are in general just still trying to figure out what's the future. We have a question about, for a very high net worth clients, how much should be private, how much should be public. And I think that there's still a question about gold and silver as assets if inflation does rear its head. I still kind of believe that they are a solution, but they're not a large scale solution for what you're doing. I still think you're better off buying some equities that have lower risk and have good dividends. That'd be my choice versus gold or silver. You can buy gold and silver miners, but it's really very regional. where this money exists. Are there labor problems? Are there problems with the environment? Are there problems, gold and silver are, materials just like all the materials we're talking about for some of the AI facilities and servers. We don't know how electricity and how some of these things will impact different communities going forward. So I'd say most clients are feeling in a sense of uncertainty. And I think that sense of uncertainty is making them hesitate as to how they want to invest going forward and how much risk they want to take. I think we've had a great run. And therefore, I think that people are naturally saying, hey, I never thought I would be worth X this quickly. I almost want to, I think people would like to take some off the table. And that's where I look and say, the question about debt is not just one for the government to answer, but it's one about whether individuals, how are we going to pay for it? Because ultimately we do how we spend our money and how we realize gains ultimately create funds for the government to do something about the debt. And I could see somewhere where you would take, individuals with, earnings over over $1 million and take some of those millionaire taxes and apply them to the debt. And in that way, they're making the country more stable and they're helping the future in such a way that it really affects everyone because everyone owns a piece of the debt, right?
Well, I mean,
So
everyone definitely owns a piece of the debt. So would that be the same thing on the other side as like the Trump baby accounts just sticking into the State of the Union? And I'm looking down there was a comment that was a question I was trying to find from the podcast we did. That's what I'm looking for. It was about ops.
okay.
Can't seem to find it.
Oh yeah, I think I answered that question, but it's
But you already answered it?
yeah, I think I did put an answer out there. I think, Marcus, that the use of options and the use of these different strategies and what you're trying to do to connect Main Street to Wall Street, I think it's a great thing. And I think what you're trying to do is talk about issues in common sense terms so that people can either feel better or do things better with their own money so that they ultimately can find a better place in financial wellness. And I appreciate what you're trying to do. I think it's really great. I think that, the next one of these we do, I hope we have more listeners and more people and we can break down some more issues.
Yeah, I think more people coming. I appreciate you taking your time to hop on here with me and just help Main Street, meet Wall Street, just some of the different terminology and jargon that is thrown out in the world, just where people they may get confused, and when people are scared, they just usually say no, or they don't make any move, they get paralyzed. So yeah, one of the big things that we're trying to do here is definitely spread the mission, spread the words, financial literacy. Like I said, you can find me and Mr. Stephen on both on LinkedIn. He's with financial literacy programs. He has some very cool tools that people can use online and YouTube. Yeah, well, we have a couple minutes before we get off. Like, tell people where they can find you, Mr. Stephen. Tell people what you do. Why it's okay for you to hop on here and just talk about this stuff. Like, who's this guy?
So I was part of a CFA group in Atlanta called the ASFIP Foundation. And the foundation was formed to help financial CFAs improve the financial wellness of the community. And what we did is we developed a series of 12 videos, each 3 or 4 minutes long, that have a central idea: budgeting, paying yourself first, investing. Each idea we tried to break down into 3 or 4 minutes where you had 1 or 2 things to do to try to help you to do that task and put yourself in a better position to start adulting. It's meant to be people in high school and early college and people who are starting their financial lives. I believe that one of the things that's funny is we're all missing one semester in our education. And that semester is, how do I invest and how do I live my life in a way that's financially successful. And I think we talk about our health and we talk about our wellness and we talk about our mental health, but we need to talk about our financial health as well. Part of going to ASFIP Foundation, there's an English set of the videos and there's also a Spanish set. During COVID, we weren't able to hold meetings with people. So we took all the money we would have done to hold meetings and we put it into enhancing the software with a Spanish language and also in Spanish text. So overall, we think that those are assets for people to use, and we hope that people will go online and look at them and use them and share them with families and friends, because all of us need to help each other. This isn't going to happen with one person or one organization. This needs to be a global effort, and that's what we want to do, is to try to make it more talked about, because if we don't talk about the problem, it's really hard to solve it. And that's why I think what you're doing here, talking about the markets and talking about Wall Street, demystifies it and makes it part of everyone's life. And therefore, they feel better about their investing and they feel better about their futures because they understand more. It's about understanding. It's about working together. And I've enjoyed working with you, Marcus, and I look forward to doing more of these.
Yes, sir. It's something, yeah, if the people want it, we can just hop on, we'll hop on and talk. I don't know, once a month. We'll do this on some Fridays. We just hop on to recap the market, what's going on with it. Where can people exactly go to find those videos on YouTube?
It's ASFIP Foundation on YouTube. So ASFIP Foundation has a new website I found out today, and it's just as I said, asfipfoundation.org. And so you can find there more information and links to the videos. You can go into YouTube and type in ASFIP Foundation, and you'll find it there too.
And if they want to find you, where can they find you, Mr. Stephen?
I work at Circa Capital, CIRCAP.com, and we're an advisor to families and individuals, and we're trying to help people with better balanced investment advice. So I'd love to talk to you, help you move along and put your assets into things that you can watch grow and give you greater financial stability. So CIRCAP.com is where you find Circa Capital.
Very good, very good. And I guess before we hop off, is there any updates on our end?
No, I don't see anything except that they're optimistic. So I'd much rather hear about optimistic than antagonized.
Yeah.
So I think that's what we're all looking for, is something good to happen. And I look forward to hopefully de-escalation and moving some of those military assets out. And let's get back to talking about trying to make the economy and the technology and the United States better.
And one last question, I guess I need to ask you this before we get off. People are on here and that we're talking about the markets and updates. The Dow is down 600-700 points. Are you buying the dip? Have you been buying into these dips?
I have assets that I put aside that I want to start buying. I don't think we're there yet. I think I would expect another 10% drawdown.
10%?
And then I would start. I think another 10% is where we're going to get to, that will be a place for us to put assets back to work. I kind of believe that one of these events that's going on in terms of credit are going to be a precipitating event that are going to cause a further escalation of uncertainty in the markets. And I think that uncertainty needs to be resolved. And we think we need to, do something about the visibility and the exposure to private credit among major banks. And then I think we will see a stabilization in the banks, and a stabilization in the banks will lead to a more stable and a better environment for the market.
That's the skeptic's thesis right there. There you go. I can dig it. I can dig it. 10%. Now that's noting that the Dow was down for the first time in 10 months, 9 or 10 months. The stock S&P had its worst month since maybe April of last year. There's still a little bit more to go down, according to Mr.
We had 3 years of greater returns, Marcus. It doesn't, I think it's healthy. I think disagreement about markets is healthy. I think that being skeptical about the future and trying to figure it out so that everybody understands it is healthy. I know it's difficult to have this uncertainty, but ultimately I think it leads us to a better place. I would much rather do this than say, I think the market's going up, and you say, I think the market's going up. We all just talk about an unrealistic expectation that leads us to inform people in ways that they're going to be biased. I don't want to be biased, positive, negative. I want to be biased in the present as things are. And I hope that what we've done today is have a good balanced discussion. I think it was. What do you think we could have done better today?
Got a few more people to tune in, but who knows? I mean, I think we've given a lot of value today. A good synopsis of where we are right now. I mean, we literally had some breaking stuff happening just with Iran. And I think if people want to get more technical, they should go to the podcast, because we have some good stuff on there where it gets technical and deep dive breakdowns on the podcast. Main Street Meets Wall Street, or they can read our newsletter somewhere, the Wall Street South Journal on LinkedIn. Check us out there. This was really good for anyone who's just getting off, seeing the madness in the markets today or this week or this month, and just wants to know what's going on. I hope we help people with that today.
Yeah, I mean, Monday or Tuesday, we're going to have Catherine Carlin, who is a colleague of mine at M&T, and she's going to be on the podcast. She's talking about a website and a charity that's devoted to helping women understand more about money. So listen to the podcast Tuesday. Catherine's Kathy has done everything in this industry, and she's going to be a great guest to talk about how to help women. And I think it's, improving women's investing IQ, just makes us all stronger as a society. So let's keep getting stronger.
Yeah, and women clearly outlive men, so that's where that's the first part of great wealth transfer is from husband to wives, and then it goes down to the kids. So yeah,
let's not make that transfer too soon, Marcus. You and I have at least a couple of more Fridays.
thanks for hopping on, Mr. Stephen. We're gonna let these folks run. I'm gonna let you run. Unless there's anything else you want to tell Main Street, anything else you want to say?
No, I think that check out our podcast, Skeptic's Guide to Investing. On Tuesday, we got a great guest, but we've got 135 episodes out there to try to help you improve your investing IQ.
Right. And what did you just put out this week?
Thank you, everybody.
What did you just put out this week, your last episodes? I'm sorry.
The last episode we did I think it was talking about gold. And I think we talked about what's happening and what we believe. We also talked about tariffs and whether we believe the new tariffs will come and succeed or whether they'll be somewhat limited. We're hopeful that maybe this tariff thing will go away. And I think there's some people saying this might be an opportunity for Trump to step back from the tariffs. And in that way, this disruption and all the other things would go away. And that would make the markets more stable and more, more positive. So I think the tariff discussion is on there. And I think some gold and silver discussion. But I think, like I said, next week we have Kathy Karlik talking about women in investing. So just keep, we want to make things better for people. Tell us what you want us to talk about. Tell us what you want to hear, and we'll try to deliver as well we can to make your lives better.
That's great stuff. This week we released part 1 on the debt with James Callahan. James is fascinating. And then with Adam Parker, today, part 1 where we talk about research and how he does his research and just markets, tariffs, some of the stuff with the SCOTUS. That stuff's coming out again next week, part 2. So tune in, check it out. We're going to let you all run. Thanks again, Mr. Steve, for hopping on. Mr. Steven, I appreciate it. Check him out. If you have any questions, y'all can check us out. Send us a comment in the chat. We'll respond to you.
All right. Be good, everyone. Have a great weekend.
Thanks. Bye, everyone.
What's up, Main Street? How y'all doing? I got a question for you before we start. This is a question from my friend Sam over here. Sam, is water wet? Is what water touches wet, or both?
I'm not entirely sure. I'm inclined to say that water is wet, but I'm not a scientist, so I've never really thought about it too much.
Perfect. And that's exactly where we are with the SCOTUS rulings, the economy, and everything that's coming out. So part of what we're going to do in this Main Street Meets Wall Street episode right here, we have an business insider journalist, O Brient. He's going to hop in with us for a little while. We're going to talk about SCOTUS. We're going to talk about geopolitical tensions. Some stuff might happen this weekend. We're going live, in case you don't know. Talk about the dead money rotation, trade policy, and the kitchen table inflation. And then we'll also talk about Main Street's impact on AI and its disruption. So without further ado, I'm going to go ahead and let Sam just jump in and start talking. Sam, obviously everyone has heard today about the Supreme Court ruling. What are you hearing on the inside, Samuel?
Hi, Marcus. Thank you so much for having me. Now, I would say that, firstly, this ruling just happened. So I have personally not heard too much. But what I would say is that based on the very smart people, almost all of whom work in finance, who I have spoken to and heard from in the past few hours, the consensus is definitely that this development is positive for the stock market because, as many have said, the uncertainty that has sort of clouded markets for months based on just the sheer not knowing what Trump is going to do, what he can do, and what's going to happen has cast a bit of a dark shadow. But, temporarily at least, that's been lifted. And most people were not surprised that market moves were a bit tepid today because, according to what I heard, it was sort of assumed that this was going to happen. Now, of course, no one really knows how Trump is going to move forward. He gave a statement and he was not happy about the ruling. So we're still in the wait and see phase, but for now, the consensus is positive for Wall Street.
Nice. Yeah, it was interesting when they first announced it. I heard them say something when he was speaking about 10% cap, and it seems like Wall Street was just kind of like, okay, we can deal with 10%. Wall Street, one thing that people don't realize, like Wall Street and these giant investment banks or corporations, they're pretty agile and they know how to figure out different moves and different things. They just kind of want the rules, and like Samuel said, they kind of want to just have a clear roadmap to whatever that may be. On the other side of that, you say, I'm hearing people respond that this actually just created less clarity. As I listened to President Trump's conference today, and he was speaking on things that they can do now, and it may take tariff levels higher, but for shorter periods of time. Are you familiar with anything like the Section 122 or parts where we can only tariff countries where we have a deficit, just different? I know this is all hot off the presses.
I have not heard too much about that just yet. Still looking into it. When my team put out a feature on the impact today, it was mostly with context from people who were reacting to the news and assessing the immediate impact on the market. As far as what may happen in the future, I think it's a little tougher to say. We know that Trump is someone who reacts quickly, and if he doesn't like something, he's not shy about letting us know. But right now, I just think because he is so unpredictable, it's difficult to say. And I think it will be moving forward.
Yeah, and that goes right into the next topic, man. The unpredictability. We're in excessive geopolitical tensions around the globe. We know that we have our largest carrier going to reinforce another aircraft carrier in the Mediterranean. What are you hearing from insiders regarding this move? Are people looking to invest in oil, or what? Are they just taking this as, because Trump's unpredictable? I mean, if you just think back to the original Iran strike, we sent our planes around the other way. He said 10 to 15 days before something happens, but he's not going to just show his cards on this move if he makes a move.
No, absolutely. Now, regarding oil, so most recently I saw an interview with Goldman Sachs's head of oil, who spoke to CNBC about this exact topic. And I believe he said that that their base case isn't too impacted by the uncertainty surrounding the U.S. and Iran's tension right now. Both nations have made it clear that they don't want to back down. And of course, Iran knows that its leverage with the U.S. lies in oil, typically the Strait. And as Goldman's head of oil mentioned, if they were to reduce oil flows into the U.S. just for the coming year, that would severely diminish the U.S.'s supply. And of course, supply and demand math make it pretty clear that this would definitely push prices up. According to what I've seen, prediction markets are pricing for moderate escalation as the base case and the long-term supply disruption as a meaningful but fairly small tail risk. Last I saw, they were signing odds that were roughly 60 to 75% that the US and Iran would see some form of kinetic escalation, which could mean strikes, could mean actions on the oil front. However, they maintain that odds of a full-scale conflict are significantly lower. I think they were in the single digits to low teens last time I saw.
Gotcha. That's very interesting. So odds that you can jump into a hot war, but not necessarily. It sounds like they're expecting for this to be a shortened engagement, perhaps.
That does seem like the consensus as of now, based on prediction markets. But of course, things can change quickly. I know that Trump gave some statements on, I don't know if he gave statements, but I know there were headlines regarding Trump and Iran today. Was focused on other stories, so I was not able to look too closely. But it does seem like that is the consensus right now, that traders are not anticipating a significant spike in oil prices, but with the lack of clarity around what's going to happen, it they can't roll out some risk that would push prices higher.
Got you. I've never played the poly market, so I don't quite understand. I understand they work. I've never done it, but I know that the odds are like they're higher or lower depending on how far out you're investing or into the when it's going to happen. The hit, the action, the kinetic motion inside of Iran. And do you know like what the odds are if it happens like this weekend?
Not specifically. I had not looked too recently, but the odds I mentioned were from, I believe from, I think yesterday. So they're pretty current. But as I noted, they can change pretty much on the dot,
Yes, they
depending
can.
on how people are feeling. And sometimes it's reactionary.
Right. Do you think poly markets, and I'm sorry we're veering off a little bit, do you think poly markets have become like predictive markets? Like it seems like you can pick the winner with those.
That definitely seems to be the definitive consensus. You might have seen that the Federal Reserve just put out a report on Kalshi, Prime Market's biggest rival, essentially touting its prowess as as a means of gauging economic outcomes. The power of these platforms has certainly become undeniable. I remember when they were just for sports gambling, people would laugh about how you could bet on the weather, but now they're everywhere. And there's no denying that investors are using them for other things. A while back, I spoke to Danny Moses, the trader from The Big Short, if anyone has seen that film.
Great
And
movie.
he was happy to tout just how important prediction markets are as a tool in the investing world.
Got you. What's his forecast for the world right now? Is he a pessimist, a bear, I guess? Michael Blurry clearly is.
The last time I spoke to him, he was still bullish on the AI market. As far as the world goes, we didn't discuss that. When it comes to conversations with people in the financial sector, I try to stick to financial questions.
And now we're going to shift into this dead money rotation, man. That was a great explanation for Main Street, right? There's been a growing narrative among tech strategists about the Mag 7 and how it's become dead money and
Yeah.
how we're kind of seeing the new economy money flowing into other areas. Based on the flow of your funds that you've been tracking, is that fundamental shift in investor appetite? Is that what you're seeing?
Definitely seems to be the consensus. Now, can I quickly explain the concept of dead money for anyone who might not know that term? So, most recently, I was listening to George Noble's podcast in which he discussed that concept with Brian Shannon from Alpha Trends. Brian is a technical strategist, and he laid out that concept, I thought, very well, in which he described it as essentially a stock that is, let's just say, unlikely to generate meaningful returns for investors over the coming period. Now, it doesn't necessarily mean a crash. That's not what he was saying, but that its price action is essentially stagnant. A stock that trades, let's say, in a range for months. He used examples like Nvidia and Microsoft. I don't think anyone would say that those are bad companies to own. They've been incredibly strong performers over the AI boom, Microsoft for even longer. But right now, as he noted, they've both been kind of stagnant price-wise. And the other part of the dead money concept involves how capital rotation is taking place in which investors are rotating money out of these companies into other ones. On that episode, the consensus was definitely that things are shifting into areas like, say, utilities and energy, areas that might not make quite as many headlines or seem as exciting as these big tech stocks, but that experts see as having overall more growth potential.
Got you. And clearly a cyclical rotation is happening, right? As you see international picks up, we've seen a shift in the value, like these energy stocks, right? The new tech stocks, like, is that what people are trading on now? Another one, speaking of dead money, a good example, and I got to put my hand up on this one, is Oracle. We spoke about Oracle earlier this year. I still have the same thesis on Oracle. Not making stock recommendations for anyone on the show Oracle, I said, would be dead money. We were speaking for probably the first half of the year, but I expected to bounce back. But it's exactly what Samuel just described.
Exactly. I can confirm that Marcus did, in fact, make that prediction multiple times when we spoke.
Yeah, I probably shouldn't be saying that on air right now because it doesn't look like the greatest one. But it's what it is. It's what it is. Let's talk about trade policy and the kitchen table inflation. We had GDP come out today that was 1.4, expected to be 2.8. And I'm hearing people talk about GDP. They're trying to square the 1.4 versus 2.8 and maybe tie in seasonality. When it comes to those numbers, Main Street, just try to take a trek of 3 or 4 months and smooth those out. But then we also saw the PCE, which is the Fed's preferred gauge. I'll let you speak a little bit about that for measuring inflation, come in a little bit hot, 4/10 versus 3/10. So if you want to jump into that for us, Sam.
Absolutely. So I think you kind of just said it all. It was a little hotter than expected, and numbers being a little better than expected has kind of been the name of the game with economic data lately. When the January jobs report came out after a 5-day delay, things were definitely better than better than expected. And of course, when that happens, the immediate reaction is to say, "Oh, this is good. This seems like the economy is rebounding." And some say it is, some say that it isn't. I have 2 different economists who I've written about recently who I can compare who have taken different stances. Ed Yardini from Yardini Research predicts that we're not going to see any kind of recession because the economy, in his view, is just too resilient. The U.S. economy, I should say. He had talked about how he just thinks the resiliency is strong enough that we are going to see what he called another roaring 20s. And he didn't mention anything about how the original roaring 20s ended in a stock market crash. So that I'm not sure about. But he did mention that and touted the growth of the S&P 500, boosted mostly by AI stocks as a reason for his bullishness. Now, on the other hand, there's Mark Zandi of Moody's, who is someone who I've interviewed multiple times and who has been very good at showing the data when he has a prediction. And when the jobs report came out for January, he shared a chart that showed that yes, it's true. In January, the numbers were better than expected, but very late in the year in 2025, the job numbers were pretty bad. They were in the red. So yeah, it's easy to celebrate when report comes in a little above line in the green. Zandi also predicted that we would not be seeing too many months in 2026 with this kind of job growth. Right now, it seems that, as they always are, experts are mixed. But those with all the data seem to be erring on the more bearish side when it comes to overall economic rebound.
Got you. Yeah, Dr. Ardeen he is one of the most bullish people you're ever going to meet. And yeah, a good point that people seem to forget about is that the roaring 20s of old ended in the Great Depression. But a lot of things are so different now versus when that happened. I mean, you have the speed of information is what I see is like the greatest difference in between then and now. They were sitting there waiting for hours to find out what happened with those trades, and people were trying to panic sell. It's just so hard to be in the dark with this stuff right now. But it does move so fast.
Absolutely. There's a great book by Andrew Ross Sorkin that recently came out on the crash of 1929 that does a great job of highlighting exactly what you mentioned. One of my teammates at Business Insider, a Will Edwards, had a great piece on it and illustrated that extremely well, that these days when people talk about the stock market crash, because we're in the 20s again, it can be tempting to lean into the mindset of, oh, it's going to happen again. But as you just said, it's definitely true that certain things are very different this time around. So it's really impossible to say.
People can have the information, but if you look back to historical crashes in the U.S., like 1907, that was, actually private individuals came in and saved the economy that time. They created the Federal Reserve, right? Because that will help us if we get into a situation like that. But 1929, when the market did crash, the Federal Reserve made the wrong move and tightened money. So they made money harder to get, raised rates when they should have lose some money. Hopefully these Fed people are learning from all of history. And then we have Kevin Warsh coming in. I mean, I know we got another topic to cover, but what are you hearing about Kevin Warsh while we're digging into this Fed stuff, man? How is that affecting the markets? Because everything went down the day that he was announced.
Well, there are certainly concerns about Fed independence. Now, based on what I've seen, the general consensus among economic experts is that Warsh is a fair choice. Those are Mark Zandi's words to lead the Fed. And it doesn't seem that there's too much negative speculation about Warsh being chosen. I think partially because it wasn't that surprising when he was chosen. As I understand it, for a long time, Trump was between two guys named Kevin, and they weren't that different as far as Fed choice candidates goes. And of course, with all the tension between Trump and Powell that had happened over the past, I'd say past few months, but really it's more like most of the past year because just so many questions and so much just not really knowing what's going to happen with the Fed, which of course is supposed to be an institution that we can rely on to always know what's going to happen because that's why they're there to help provide these economic answers. And based on heard though, it does seem like the market's response to Warsh's appointment might have been a bit of a knee-jerk reaction, and that I remember some experts saying that when the dust settled, conditions would stabilize fairly quickly.
The last part you said again?
Based on my understanding, some economic experts had definitely said that once the initial shock of Warsh's appointment sort of wore off, market conditions would stabilize because ultimately he was seen as bullish for the stock. His appointment was seen as bullish for the stock market.
Whenever a new Fed chair comes in, the market always finds something. Something's always happening. I don't know if it's causation or correlation where that Fed chair is challenged. I don't think anyone, even on the finance committee, has a problem with Warsh. I think he was nominated unanimously last time. I think Chuck Schumer brought him to his nomination. So I don't think anyone has a problem with him. I think, and down here in North Carolina, Wall Street South, Tom Tillis is my senator. He has a problem with the process going on. We're not going to dig into all that right now. I want to dig into one last point on how Wall Street, everyone's still worried about AI. I was talking to Adam Parker earlier. That episode will come out later. And we just talked about, he gave me examples of how AI can disrupt his industry, specifically what he does. He does research at Trivariant for the institutional investors.
AI is disrupting essentially every industry. And it seems like the question's too big to, sure. I mean, not too long after, Marcus, you and I actually discussed discussed the impact on stocks in the on brokerage companies like Schwab and Fidelity, because of course an altruist rolled out that update, and of course this came just after the software sell-off, and of course I remember stocks falling, but it wasn't anywhere near to the point that it was what was happened to software. Brokerage stocks bounced back fairly quickly, even after it became common knowledge that Altruist had the little update that was, I should say, the plugin that kind of enhanced its capabilities for financial advisors. Ultimately, as far as AI disruption goes, it's difficult to really say overall, other than the fact that it seems poised to disrupt most industries. But I do have to give you credit for being correct when you told me that you didn't see the altruist news as having a long-term impact on brokerage stocks.
Well, thank you. And yeah, Sam and I, for those who don't know, me and Sam have done a lot of stuff together. Sam's a really great journalist or writer. I don't know. I need Sam to elaborate on that at some point, the difference. But we've done a lot of good collaborations, I don't think, throughout like this whole entire year, last year. But yeah, one of the things I saw is like Altruist, and full disclosure, I use Altruist as my custodian. Altruist uses Hazel which is the AI tool to enhance advisors so we can help our clients in that type of way. Boom. You heard it there. AI can't do that. I love it, Sam. That's good stuff. Like I said, I want to respect your time. Sam was only going to talk to me for like 10 minutes, I think, and I just kind of stole him, and he's such a wealth of information, man. I appreciate it, Sam. If people want to get in touch with you, or if they need anything from you, how could they reach out to you?
Well, the best way to reach me is on LinkedIn. But if you have a tip or a story you think I should hear about, I am reachable at SOBRIENT, last name, at insider.com.
Got you. And the LinkedIn was fine, the Business Insider, where if someone wanted to send something in, what would you say?
Yes. So I am reachable at SOBRIENT, first initial, last name, at insider.com. And I'm also on Signal. If you'd like to chat with me on there, message me. We can go from there. The only place you can find my work these days is on BI. Marcus, thank you for having me. It has been really great to chat, as always. Thank you all.
Whew. We spent the last hour in the war room, but now we pivot to the kitchen table with our friends over at Policy for Normal People. But before we talk domestic policy, remember, March and April are dropping this weekend. If you haven't subscribed to the Main Street Meets Wall Street podcast feed yet, this is your moment. Don't be 24 hours behind the economic fog. Hit subscribe on the YouTube channel.
Hello, friends. Welcome back to Policy for Normal People. I'm your host, Christy Amado. I'm joined by special guest Marcus Sturdivant Sr. of the ABC Squared. We meet once monthly, although we've taken a little bit of a hiatus the last couple of months with the holidays and my absence for other reasons, but we're back into it here in 2026. And this is our special episode of Policy for Normal People that I like to affectionately call the monthly market update with Marcus. Marcus, how are you?
Hey, Christy, I'm doing great. Thanks for having me back on. So good time. Always good to see you. How are you?
Yeah, you too. I'm doing great. Got the new year started off strong enough, but I am anxious to get an update from you on market activity, what's going on with Chairman Powell, how are things going with that? Lots of new proposals too. Everything from credit card rates to the Trump baby fund and everything in between. Affordability is a big issue right now, whether that's housing or otherwise. So thought I'd turn it over to you, let you give us some highlights of what you're seeing out there, what you've been talking about in other spaces. And then I've got a specific question I want to ask you later about the credit card rates, because that's probably the thing top of mind for me right now that I'm just curious about.
Perfect. Yeah. All right. Well, let's jump in. So yeah, as we sit here right now, recently we just had the Dow Jones hit 50K. That was a big mark for investors to see, but it came back down. The markets have been in turmoil, really volatile start this year. As far as stocks and trading goes, the things that were leading last year, so like tech and those industries, are now lagging. We have industries like industrials and materials are starting to lead. People seem to be moving towards investment styles right now where they're trying to figure out what can't be disrupted by AI. It appears that everything is in a rolling cycle with what is being disrupted. We noticed a few weeks ago, we had the Claude incident. It was like 2 Fridays ago, actually, where we had the Claude incident where he came out or announcement, I should say, where they came out and announced that they had an agent that could do a lot of the legal work, paralegal type work. So we saw companies like LegalZoom, a lot of SaaS, software as a service companies go down, CRM or Salesforce, Accenture, companies like that, where they have a seat-based model. So they're paying money per seat. This just seems to be a model that is going to eliminate some of those seats. Inside that, we saw a sell-off in that. Then, like earlier this week, we saw Altruist come out with a tax planning tool called Hazel. That shook up some of the fintech sector, where we saw companies like Schwab start to go down. Robinhood has been going down in correlation with cryptocurrency, as we've seen the swoosh from Bitcoin. I think when we started talking, or back in around October, Bitcoin was like 120,000. It's pretty much half that since then, down in near 60,000.
That's a big dive.
It's a big dive, splits in half, but Bitcoin is also something that rotates on cycles. So like every 4 years, it halves. But so that was another scare to the fintech side of it. And then today we're seeing, I think we're seeing, what is it today? There's another disruptor today. It is the garbage industry, maybe? No, it's trucking. It's trucking. There's an AI disruptor coming in trucking that can help small companies use their freight services more with to compete more with large companies. Freight and supply chain, that stuff's so important. It's also something I study in schools. It's just right now we're seeing the AI disruptor. So inside the actual stock market, we're seeing the market rotating out of what we've seen the last few years and growing into a different kind of market with a different kind of economy. And that's not even talking about the policy and the inflation and the data that we have.
Yeah. What's going on? What are you seeing, like companies like, the big companies like NVIDIA, Microsoft, and all of them who are, I guess, Amazon too, maybe, that are really investing heavily in data centers, which of course, is connected directly to, the demand from AI services or AI adjacent services. What are you seeing there? I've heard some things about that there may be a bit of saturation, that some of the smaller investors in it could suffer longer term because a lot of people have jumped into this and not everyone is going to benefit. What's your thought on that, or what do you see?
Right. So what we're seeing right now, as I mentioned just a few minutes ago with the software, you mentioned Microsoft and NVIDIA. So those are perfect examples. Microsoft seeing more of a software play. I know a big thing right now we're hearing is the K-shaped economy, but it's kind of K-shaped with the AI play as well right now. So you have the software companies like Microsoft, which are going down. NVIDIA, software companies, people who are making the chips, were continuing to go up. So that part of the tech sector was actually up a little bit this month or for the year, but where we saw the software part of it pulling it down as a whole. So it is separate and it's divided. One big thing, I know we spoke about it months ago.
In October, November.
It was local to where I live, down here in Wall Street South. That's Charlotte, Wall Street South, not my creation. They were looking at building a data center in a little local town, and the residents rejected it. Now we're starting to see that more, where people don't want data centers built near their homes.
Yeah, that's absolutely true. I see that in my home state of West Virginia. They're fighting it hard in the southern part of the state. And they're fighting it here in Northern Virginia, too. I mean, I think sometimes the residents are losing in this part of the country, or in this part of the state, rather. But yeah, there's definitely a pushback. And I don't think that we talk enough. This is my personal view on this. I don't think we talk enough about the consequences of data centers. We talk about money to be made. We talk about all the advantages. AI is revolutionary. I mean, I use it every day in running my business, but at the same time, I don't think we talk enough about the impact on the ground with people. So that's interesting to hear. That kind of confirms, what I've been seeing and hearing as well.
Right. And then the impact on your wallets. These data centers consume a lot of energy. We just got the inflation report earlier today around 2.5%. But if you look at electricity inflation, it's like 6.7%. So there's so much inflation inside electricity. Then we just had these storms that came through. So the seasonality in that will increase your costs. The heating costs are going to increase, or energy costs are going to increase when we see these storms come through. Also, another reason why you see, as they construct these data centers, we're seeing investments going to companies that are used to build them. The picks and shovel type companies right now, people that are actually going to be involved in building the data centers. So you see a lot of that right now as a shift inside the AI by investments. And investments still happening. Mentioned capital expenditure earlier as well. People are worried about the level of capital expenditure that we're seeing out of these companies and whether it can be sustained. That's TBD. These are some of the largest companies in the world, some of the greatest companies in the history of the world. If you look at the history of just business and technology, some of the greatest free cash flow that we've seen, but they are now tearing into some of their free cash flow. I was in a call yesterday with an advisory board, and they mentioned how I think it was Microsoft is spending, no, it's Google. They're spending like 40% of their total revenue on capital expenditure, not their free cash flow. Total revenue. So that's just a huge shift in AI investment.
Yeah. And I was going to ask about that. I mean, maybe you can help me understand a little bit better, because I read things that seem kind of confusing to me. I'm not an expert in this field or anything. And, when you see things like these companies that have massive, that they have massive amounts of funds. And of course, that's not all liquid funds as we know, but nonetheless, I mean, they're still taking out loans to invest in the AI boom. Why would they do that if they have, risky?
Right. Well, it depends on how you want to finance this debt, right? So Oracle, we spoke about Oracle before. That was the poster child for Oracle. They went out and financed a lot of their build out for these data centers via debt versus pledging some of their securities or selling some of their stocks. One reason could be that you fix the rate on that debt, 5, 10%, whatever the rate may be. Whereas if you have a stock, that stock could go up 10, 20, 30%. Who knows what that stock move could do? And then on the person who's taking that stock or whatever as collateral for that debt, they know that stock could also go down. So maybe they're not as secure as taking that stock as collateral for that investment. But yeah, generally when you finance things, businesses, when they build out, they do generally go out and finance debt. But the level of debt is the problem, and the return on investment. See, that's the thing. People have been hearing about AI. We really start hearing about AI like 23, 24, 25. People want to see where's the return on investment now, right? Where are these dollars coming back? People have been spending hundreds of billions of dollars to grow out this AI infrastructure. So they want to see where's the return on investment, the ROI, in these moves with data centers.
Yeah, sure. I mean, you can only give so much leeway to the spending side, and then you want to start seeing some return on investment, and that would include the average investor too. I mean, I'm curious, how much has this phenomenon, this AI revolution, and the investing that at the top going, how is that affecting the average person's, say, retirement investments and things like that? How should the person on Main Street think about what that may or may not do, or does it impact really, at least yet, things like retirement funds and long-term savings?
It definitely impacts retirement funds, depending on your person's age. If you have a longer investment time and you own like individual positions in some of these great companies that are going down right now, this is a great opportunity to buy these companies at a great price and see the appreciation in years from now, right? But if you're a person who's about to retire next 6 months, hopefully you already repositioned your portfolio where you weren't in so many individual stocks anyway, but more towards, if you do have stocks, you're on the indexes. The market has been broadening out this year. So that's another thing that we've noticed with the market, right? The equal weight markets, the markets and the way the indexes work, some of them are like weight cap. So the bigger the stock, the bigger the percentage, like NVIDIA, the Mag 7 is a build out where that's like 30% of the S&P 500. Then there's also a thing called an equal weight market cap, where they just take the stocks and divide them all up and everyone gets an equal amount in the stock to where it equals out the industry. So in those type of positions, NVIDIA and companies like that don't have as much of a move. Those companies, if you have the equal weight portfolio or a stock index like that, they perform much better this year than those indexes that were skewed heavier towards the Mag 7 layout. So ideally, if you're going closer towards retirement, you're going into a more diversified portfolio that way anyway. You're going to have something that's more broad span. So when you see the moves and you see you don't get the volatility up, you don't get the volatility down. You're positioning yourself. You've already accumulated your money. Now you're getting into a position where you want to get into the distribution portion. So you shouldn't, if you're looking to retire, you're about to retire soon, you shouldn't be heavily investing in these things anyway. Play it via index if you have to have stocks. But if you have time, I mean, I'm saying more than 3 to 5 years, invest. But know that these markets can go down and they will go down. We're in a midterm election year. We have a new Fed chair coming in. We have geopolitical turmoil going on. We don't know where the data is with the inflation and jobless claims right now.
Yeah. And tariffs, I mean, there's still, a lot of those haven't taken their full impact, not even close yet. I think we'll see that, this year much more than last. Wouldn't you agree?
Yeah. So, yeah, man, with tariffs. So, and you have different reporting on tariffs. So we have one report coming out that says the American people are bearing the burden of the tariffs costs. Then we have inflation that comes out like today, and the places where you're looking, where you would expect to see the impacts of tariffs, is like these numbers are cooler, 2.4 versus 2.5. Where is it actually
question about gouging. I mean, that makes me question about price gouging too, because prices seem to go up immediately when we started talking about tariffs. But tariffs take a while to take effect. We talked about this in earlier episodes too. So that's kind of interesting that there's two sides of that story being told right now.
That's the country we live in. There's two sides to every story, right? It's good when we have this platform here where we don't
sometimes more than two.
Well, yeah. 3.
Yeah, you're right. Yeah, that's part of that. That's actually why you and I do what we do, why we do this every month, And friends, just a reminder that the ABC Squared, Marcus, I love what he does. He tries to help Main Street meet Wall Street by providing financial literacy. And this podcast is just one example. I'm really grateful that he's willing to come on and help, my listeners and viewers with that. But I know that's a core part of your services at the ABC Squared, is it not?
Yeah. So financial literacy is a big thing for me. And, financial planning, financial advice. That's what we do at the ABC Squared. Yeah. But just kind of like what we were just speaking about, those type of things we help people out with, not just investments, but like if you have longer in the market, maybe you should be buying more right now if you can afford it. Affordability is a really big thing, big issue in America right now. I heard a stat that your dollar from 1997 to today has lost like a third of its value. So, right. So people are like, I'm staying safe in the dollar. I mean, think about it. Think about how much things cost in like 97. Think about how much a gallon of gas costs versus how much it costs now.
True.
Right.
Yeah, for sure. No, it's a real effect for sure. And and the dollar doesn't go as far.
It doesn't go as far. And then the dollar has been weakening historically levels, the last few years. It's kind of caught a little bit of foot in here recently and moved back up, but that's also tied into geopolitical uncertainty. The dollar is no longer the largest reserve currency in the world. It's now gold.
Wow. Just think about that. I mean, just chew on that for a second. I mean, that's kind of a harkening back to the past, isn't it?
Right.
When people had more faith in gold, and before we went off the gold standard and all of that. So yeah, that's kind of tough to get your head around.
Yeah, Britain's dreams, the gold back in the 70s when Nixon went off of it. But yeah. And it's back, and we're back there 50 years later.
Well, that's a kind of a great pivot to something that's been on my mind lately. I know there's a lot of other things that we'll probably hit on here too. There are two policy proposals that, of course, pretty prevalent in the news right now, proponents and opponents on both sides. So first, let's talk about the Trump baby fund. Tell me what the latest is with that. Is that gaining any traction, and what does the debate look like around that? I haven't followed that real close, but I'm interested in what you have to say.
Gotcha. Yeah. So Trump baby funds, also something we were talking about a long time ago. People should go back and check out.
Long time ago. Just wondering where we are now.
Because that was before July 4th when we were talking about this stuff.
And I want to know how we get the funds in the fund.
Right. So that's one thing. Okay. So the funds. All right. Let me slow down. So the Trump baby funds, they are live. Well, you can sign up live. You go on the IRS form. It's IRS form 4547. President Trump.
So that's available now.
Trump's president number 4547. You can go on there and fill out the form. I actually went there and checked it out the other day. I need to fill it out for all my children, but I went there and looked at it. I didn't fill it out. I think I might make a YouTube video.
Yeah, you and I are in different stages of that game, but I've definitely got children who are going to be having children before long, and that'll be relevant to them. So yeah.
Right. So you go on there and you fill out the form. You just basically put in your information. You put your child's information. You have to have a social security number. Obviously, they have to be American citizens. If they were born in between 25 and 28, they'll get $1,000 seed money from the Treasury, from the people. So they'll seed the money. The funds and the accounts go live July 5th. And this is what I've heard Secretary Besson say. So it's coming straight from his mouth. July 5th is when the accounts will go live. They'll be, like I said, so there'll be $1,000 seed money for people born 25 through 28. But anyone under the age of 18 can open these accounts. We spoke earlier how, in my opinion, I thought these accounts were going to be a move to induce private sector investment into children and into America. And we've seen that. We've seen more companies do it. We saw the Dalios family do it. We've seen the Dale family do it. We've seen JP Morgan do it. Bank of America is doing it. The NFL is doing it for employees of their corporations. So we've seen this expand to where more children are going to get more funds. So these are pre-tax accounts that grow into, you can take money out when you turn 18, but ideally in these accounts, you want to let them grow into like retirement accounts, right? You want to let them grow until they're like, so you're like 65 or 62.
Do they go into a trust fund automatically, or is it up to the parents to decide?
And when you turn 18, that's when that's when the kid takes advantage of it. Yeah. And they're invested inside mutual funds, investment funds that are strictly U.S. funds. So they're going to be invested inside the U.S. In index funds inside USA. So it's also a big part of financial literacy. So kids can look and see and say, because if you own an index fund, you pretty much can walk anywhere and say, I own a little bit of that, I own a little bit of that. Some people like that. Some people like to walk in and be like, go to McDonald's, say, I own a little bit of McDonald's, things like that. Some people take it too far, and they're yelling at the cashier about how they own part of this company. But, I mean, it's like, but it is a good thing. It helps kids, because a child will see in their 18 years, they'll see the stock market move, they'll see it go up, they'll see it go down, they'll see how it works.
Well, what a great kind of tool for financial literacy, along the way, like start early, right? I mean, one of the big criticisms I have of my generation, the Gen X generation and ones before it is really, I think schools are doing a much better job now of teaching financial literacy. I don't know how the comparison would be between private and public, but I know that my kids went to a private school in West Virginia, a small private school, and they did teach financial literacy and they did a pretty good job of it. My son actually got his degree in finance, and it seemed to me like they had a much better foundation than I had growing up. It was just not taught. Economics class did not cover it. I could see this as a instead of having some kind of fictional scenario, you've now got a real time, real life situation that pertains to you, to your child, to be able to teach that child along the way and not wait too late for them to understand investing and make smart choices.
Right. And this is, yeah, exactly. The more you know, the better. And this is also a way that other people inside your family can invest inside this account too. I mean, there already are other accounts though. So let's not make it seem like this is the only account like that. Like you have 529s, you have other investment accounts that you can place for children, but this is a government initiated one. You can contribute up to $5,000 a year. They have some estimates that show you, and once again, you know, it depends on where the bureau is coming from, where you're getting these numbers, but that show that if you were to max fund this thing $5,000 a year up to like 18, by the time you're like 65, you would have 7 figures, and you would be set up. Once again, like I said, these are pre-tax accounts, so that's one of the things it doesn't click with me, because when you have the pre-tax account, that's kind of just like a long setup loan for the long setup loan for the government in the future, you know, when you have to pay that tax bill. Because if you start with
it comes due eventually.
If you start with $1,000 and it ends up at $1 million, you're paying taxes on that growth.
Yeah, and is anybody talking about that? I mean,
we are
just us normal people, right? Yeah, that's a big concern. I don't know that it would, you know, be something that be that would cause you to say, let's not do it. It seems like there's a lot of advantages as we just talked about, but I think that's a consequence we would want to look at, much in the way we would look at inheritance tax or something like that. You know, how do we address that? But yeah, that would be quite a tax bill that would come due, later on in life. And it could come due later on in life, as is often the case, at a time in your life when you're older, you maybe have more health problems, you've got other things that can eat into your savings and the benefit you would get from that retirement. So yeah, hopefully we won't ignore that part of it, and we can figure that out. So you were saying that other people can invest in it. Would that be like parents themselves, things like that, so family members can contribute? Now I'm gonna be a devil's advocate here. Is this also an effort to whittle away or do away with eventually the Social Security net that we already have? Because I know that there are plenty of libertarians out there who would like to do that.
What kind of net are you talking about? The one with some holes in it? Yeah. So yeah, eventually probably
Social Security.
Yeah, probably. You've heard the rumors that eventually this probably or possibly could replace Social Security. Maybe. I mean, a lot of people, but on that same note, a lot of people worry that the government will turn this into a sludge fund, as they say Social Security is now, right? They'll just take this and turn it into a sludge fund. I don't know if you'll be able to do it quite as easily with this fund. These will be individual accounts. Social Security is, but the children will be watching them. It'll be minor. The people will be more interactive. And you can take the money out at 18, if you want to. You can take it out like 35. And this is without penalty. You just pay your taxes if you want to play like a down payment on your house. But if you were to take the money out before that, you would pay the taxes and the penalty on these Trump baby accounts.
So the people who turn 18 that are going to benefit from this as babies, they need to come and see you at the right time if they're going to empty that fund and make sure they're investing it in a good way if in fact they're going to cash it in at a younger age. Yeah, very, very interesting stuff. I'm curious to see how it continues to play out. Another thing I'm interested in talking about this morning, we can kind of close with this, is so Jamie Dimon, CEO of JP Morgan Chase, also board chair. He was at the World Economic Forum recently talking about, and plenty of people are talking about this, the 10% cap on credit card interest rates that Trump is proposing. And of course, the executive branch cannot sign an executive order to make this happen. It's something that's got to go through Congress, as we know. But the president is pushing it heavily. I'm going to be, again, maybe devil's advocate, maybe angel's advocate, depending upon how we want to look at it. But I feel like there's a big elephant in the room in the debate between proponents of it and the opponents of it. And I'm just curious what you've been seeing, what you think about this. The elephant in the room that I'm talking about really is I feel like both sides are happy with a largely debt serviced economy, having massive amounts of debt through credit cards, among other things. When you see folks like Jamie Dimon who are sort of tongue in cheek about, well, let's test it in states like Vermont, Massachusetts, which are, of course, heavily Democratic states, and also a high population of college educated folks who support the high regulation on the financial industry and banking. Others on the other side of that, of course, Jamie would be one of those, bankers who do not support excessive regulation. But you see this conversation happening where the opponents say, look, it's going to severely affect 88% of the population's access to credit. And that's a bad thing because people rely on credit cards to pay bills, to buy medicine, to just survive. And then you have the other side that is saying, well, maybe it will force people to be more responsible with their finances, with their budgeting and things like that. I see some truth in both sides, but I also, again, come back to, I don't hear in any of these debates on either side of this issue a call for how this could, if done correctly, help people to regain some of their agency over their and budget better, but also recognizing that there are forces in play that put people in this situation, lower wages over decades that don't keep up with either inflation or the market in general. What are your thoughts on the 10% cap?
So
I unloaded a lot on you there, but
no, you're fine.
it's something I'm curious about.
Yeah, it's something, we've been talking about 10% cap. We were talking about with the Charlotte Business Journals, Yahoo. It's been a big topic. So 10% credit card cap. I mean, like with most things that I see, the president, he kind of like put out the trial balloon. He'll say something and then just to see where he gained traction. And then he kind of made a more direct statement. And when he did, you saw some people actually go into action to try to make these things happen. Like Bank of America down here started working on a card specifically to meet that criteria, right? And I'm going to get into your deeper question, but what people have to realize is that there are already cards like this. You already have cards with 0% interest, cards that you can roll over and
especially for transfers.
Right.
A lot of times it's temporary though, isn't it?
Eliminate your balance. Well, the terms are usually longer than the year cap that President Trump is proposing. He's proposing a year cap at 10%.
That's true. It's only a year, and a year doesn't do a whole lot, in my opinion. I mean, especially if you're, I think the average credit card debt is somewhere around $6,500 for families. That's kind of where it's landing.
Yeah, and credit card, the rate is in the 20s to 30s, just the average rate. I think it might be like 18 to 25. So yeah, so with the year, what you would have to do if you were attacking this problem as a household, as Main Street, you would have to figure out a way to, so are they going to cap this 10% on your existing debt that you already owe, right? But if you get to the 10% cap, you want to work on paying down that debt you already have. Like you mentioned, people aren't just going to change their habits. If you take it to the people in Vermont, I guess you're based on the factors you made, stated that they're better set up to make financial decisions, manage their credit better. So versus someone who's not in these other states, they're going to have to change their habits to people who already don't qualify for these type of credit cards. Another thing is they'll, like you said, I don't know if it's up to 88% of people, but a lot of people will just lose access to credit via a credit card. They'll have to go to like check cashing places or something like that. And then where they'll end up with even higher rates for their credit cards. Some of the stuff that they'll be taking loans out and credit on won't even get reported back to their credit agency. So they won't even improve their credit score by paying off this debt if they're disenfranchised from the credit industry. So yeah,
that's true, because that's a good point, because you build your credit by paying off debt. You don't necessarily gain a good credit score by not having debt ever at all. You kind of, you find yourself, I know when I was a young person, I realized that I probably needed to get a credit card, even if I could pay, I was able to pay for my expenses, thankfully. Having a credit card, putting something on there and then paying off the full balance is what really accelerated the credit score.
Right. And now they've even like updated the models now to where it reflects more recently to how you're using your credit in real time. Like not so much as like paying off your debt obviously is good every time. If you can pay off your credit card debt, do that every month. Yeah. That way you don't pay any interest. But you're looking to see if people are trending in the right way, like getting better at utilizing their credit. That can help with your credit score. Now it's a more dynamic experience, I should say, with the way the credit agencies and model systems rate your credit now, as it was much more static before. Just with the speed of information is how we move now. But back to the affordability. So in general, so this is an effort, I guess, by the administration to cap affordability or to combat the affordability issues that we're seeing. So if you cap these credit cards at 10% and people are paying off all their debt, which honestly, I don't think most people would, or we wouldn't be in a situation where we're having this conversation right now. Right. We got here for a reason.
And a lot of people can't. They just can't. I mean, the economy, this is the thing that I think I have a little bit of a pet peeve on. It reminds me of the whole, I see Diamond and others as kind of the descendants of the Jekyll Island crew, right? That set up this, sort of credit debt serviced economy, and it's built and built and built over time. And I feel like nothing we're talking about. I feel like the 10% credit card cap has opened the door to talking about where the gaps are, but I don't know that any of the solutions being proposed are fully addressing the real issue. Again, that kind of elephant in the room. I mean, the advocates of, well, people are going to lose access to credit and that's the only way that they can maintain their lifestyle. And I'm taking out of that people do make bad choices on their own, right? I mean, that affects your credit too. If if you're buying things that you don't need or, in excess, but plenty of people are buying things they need to have, buying things for their families, their children, and don't have a lot of choice in that. And so the debt continues to mount, even if you're paying the minimum balance. So I guess I'm just kind of glad in a way that it came up because it is making people talk about these things more, whereas we've just sort of accepted as a society that, plenty of people are in debt, many people much more than, and if you take students, they've got student debt that's, way more than that average credit card, 6,500 or whatever it was.
Right. And yeah. So like even at the 10% cap, like you mentioned, it's just it's a Band-Aid on a broken, chopped off arm or something. Like it's not going to be enough. You mentioned the debt and how we've become just accustomed to going deeper into debt and just operating from that. That's part of how the government operates as well, right? Ever since we last seen a balanced budget, quote unquote, back in the Clinton era, the government issues debt, the government operates a debt and a deficit, right? We're operating a debt and a deficit, but you can shrink that debt and that deficit with growth. I think that's what the government is trying to do. They're trying to cut the spending, cut rates, which will accelerate growth on the top side. But so you have to catch that inflation if that's your plan. Just run a hot economy because it can run hot and then you're stuck with historic levels of inflation again. So then if growth is growing at a higher rate than inflation, then yeah, that gap can decrease the deficit and decrease your debt if you're paying back your debt. As they're looking to lower these interest rates, I don't know if you noticed this morning when the inflation data came out, the 10-year treasury, I told you I'm watching the 10-year treasury. I always watch the 10-year treasury. It went down to like 4%, so almost at 4%, where like last week it was up to 4.3. So that went down. If the amount that we're paying to finance it and the 10-year debt isn't what their 10-year treasury is not what the government's going to be paying the debt on. It's more like the 2-year treasury. But as those levels go down, that's going to cost less money to pay off the debt in general. And this whole theory, so that's a macro theory, right? But in theory, it should trickle down to the micro, right? To our households. Like people should be spending less, or things should cost less for people as wages grow. And that's been a big part of the problems. You say affordability, wage growth just hasn't kept pace with inflation.
And then you have the job. What's the unemployment still like? What, 4.3%, something like that?
Yeah.
The last number I saw. And, going back to what we talked about in the very beginning of the episode is there is so much fluctuation, so much uncertainty, but geopolitically and right on the ground from, the effects of inflation. But also we haven't talked a lot about, at least in this segment, but it's a big factor is that unemployment rate and the job market, because a lot of these companies, for instance, that are investing heavily in AI, part of the reason that they are offsetting that cost is by downsizing their workforce. I mean, we've seen massive layoffs here lately in the tech sector. So, and that's not the only sector to consider, but all of those things, that's putting people back into a situation where they may have to use more credit card debt to get by until they get that next job or, get on their feet again.
And then another piece we're not even talking about is immigration in this whole situation, right? So we're going to see net negative immigration for the first time in a long time in this country, right? Let's talk about how this literally impacts Main Street. You want to talk about how it impacts your house? If you want to buy a house, okay, let's say you're going to buy a house. A lot of these immigrant workers were builders, right? The cost to replace these workers, this isn't stuff AI isn't doing now. I know I mentioned a robot that was laying bricks, but it's not replacing builders and workers right now, right? These new workers that are coming in are going to require higher wages. There's going to be less of them. So it's a supply demand input cost right there. There's less supply of houses already. So as the cost of these workers come in, the cost of these goods go up, Main Street has to pay more just to buy their house. With that inflation alone, that impacts into the inflation, right? So that's wage inflation. Same thing with farmers, right? Out in the middle of America, you have machines and things that can pick up these your crops and harvest them, but certain things humans have to do. A lot of these workers were immigrants. So now, once again, when you replace these immigrants, you're going to have to replace them at a higher wage than you were probably paying them before. So it's going to cost more to get this stuff from the farm to the table. and the American people are paying the price of it. So that's how immigration directly impacts inflation and hits Main Street.
But haven't we for a long, long time, with the massive increases in immigration, both legal, illegal, because, we have workers in either of those areas. I mean, in a way, we've kind of created this situation a long time ago by replacing U.S. born workers or deterring them their incentives to take these jobs, even if they're temporary jobs where they move on to something else. And you also have the sheer impact of population growth. Like, there are some positives to the reduction in immigration numbers, just speaking specifically about the numbers, not necessarily, not talking about people themselves or where they come from or anything like that. But, more demand comes from more people needing the same things. So immigration has been sort of a positive and a negative in that regard, has it not?
Immigration, and give that to me again in the regard of.
Yeah. So, we really opened the floodgates with immigration in terms of just the volume of people that come in annually, right? Whether that's legally or illegally. These are people looking for jobs, and that's in competition with the U.S. born workforce. And also, we're talking about immigrants that, are here on a green card permanently. So you've got a massive influx over decades of new people coming into the country. And then you have a situation where people are in the country are competing for jobs, and every sector behaves differently. But in general, when you're talking about, we bring in 1.5 million, about 1.6 million people a year legally who compete in high wage jobs, but they still get paid less than U.S. born in STEM jobs, for instance. And then on the lower paid jobs, lower skilled farmers, meat packers, that kind of thing, dairy farmers, dairy workers, they're competing. They've pretty much replaced the U.S. born or legal permanent immigrant in those jobs where there used to be U.S. borns. A lot of people say, well, Americans won't do those jobs, but they won't do them now, but they used to when the wages were higher. So my question is, even though there may be some pain involved initially, have we really been operating in the true market anyway by bringing immigrants in to compete with U.S. born workers, increasing the population, which also increases the demand on resources such as housing, especially? So is the drop that you mentioned now, is that necessarily a bad thing? And short term, there may be some adjustment and pain, but could it be better long term?
So purely financially speaking, from immigration, so the people you're talking about coming in, even at lower wages, they're not the people who are being removed from the country. Those people are earning a ton lower wages than these people coming in on H-1 visas, right? Even if the people coming in on H-1 visas are earning less than their peers. So that's what I'm saying. Like, that's where you see a big gap in the price inflation or wage inflation, or the people who are doing these jobs, like purely strictly cash, the people who you're picking up at Home Depot in the morning and taking them out to work day jobs. Like, that type of immigration is going to see the largest wage increase, right? Because you have people who you're just paying on the table, and now you have to get people and actually pay them, put them on your payroll, which is a whole nother thing that adds layers to your business and your inflation. No, immigration's fine either way. Set your policy, have your people come in. America was built on immigration. The jobs, like you said, people.
Well, every country can claim that. We all migrated from Africa eventually. You got to go back far enough. To me, that's kind of a straw man argument, respectfully speaking. What country hasn't experienced immigration to increase its population? But to me, that's not an excuse to say, well, economically, we shouldn't tie immigration numbers to the effects it has on the residents of a country. I just, our immigration policy should be tied, I think, to how it affects us economically, not just in terms of what's good for business, but also what's good for workers and their wages.
Well, there's a whole psychological aspect to that as well. You have people who are legal or illegal or immigrants, whoever, that they're working, they're contributing to their community and whatever type.
Right. But is it good to have that when they're kind of indentured? They also don't have the protections of OSHA or the safety protections and things like that. But I know we're getting away from finances.
Yeah, no, they're fine. But not to veer too far away, but the people that we're referring to, these people who are coming up here and taking these jobs or whatever type of. So globalization was a whole thing with all this. This was a big move of globalization. We're giving you some more information. You're giving us some more information. This stuff started way back before we're talking about now. We're trying to I guess, fix a problem that we create ourselves, which you mentioned, right?
Yeah.
Growing
Yeah.
up, there were manufacturing jobs in the 80s, stuff like that. People work, you could work that manufacturing job 4 years, retire, take care of your family, right? That type of
Right.
stuff.
Right.
Have your pension.
That's all different.
That's not the way now. People are coming to America to take jobs for whatever the wages are, because where they're leaving from, not getting political, is, I guess, such terrible conditions. You know, there are such terrible conditions that they would do anything to get away from these places, walk thousands of miles across the peninsula to get to a country to come in here.
Sure, you can understand the motivation. I'm just referring to what should the United States be doing in terms of its own economy and its workers to make sure that there's some equity in protecting people who are citizens and who have come legally, especially, and done it the right way. So I have a affinity for following the law, especially if it is going to undermine the economy, and it has. I mean, we've hollowed out a lot of those lower paid jobs, and you're right. People who are coming from far worse conditions in other countries, they're going to take whatever wage here they can get. Plus, they're coming for a certain degree of safety, and that's all understandable. But at the same time, we have plenty of people here who are homeless. Millions of homeless people. We have people that are struggling to find jobs, that are losing jobs, competing in various sectors. Of course, the competition is not a straight line. It's, every sector behaves differently depending upon how many people are competing for those jobs and what the demand is and what the employer needs are. But getting back to what you were saying about, just the
one more thing on that, just like going back, you got to realize, like,
sure.
America was built on capitalism. Like, if you operate in pure capitalism, which we don't, because there are regulations, like, it will be
it's a mixed economy,
killer place. It will be the cheapest labor to get the highest return. And America started at that. Like, it literally was the cheapest labor for the highest return when America started. Not getting political. So that's hundreds and hundreds of years of how this economy has gone. We're capitalists. People complain about capitalism, but
that's why treating illegal immigrants so badly. They get the jobs, but they don't have the protections. They don't have the thing. They are living in many respects in ways that prior centuries we have treated our laborers, when there weren't any labor protections. I mean, that's how a lot of them are functioning. Exactly. Yeah. Child labor. And well, we saw that. I mean, there was a big story done in the New York Times, series of stories actually, about poultry plants right here in Virginia, not far from where I live, that were hiring child labor, immigrant child laborers. And because they were here getting paid under the table, they didn't have any protections. So, yes, I care about our prices being higher, but I also care about safety for those immigrant children as much as I care about how immigrants coming, not through any fault of their own, but it's just a natural competition that's being created, and it's it's affecting the job market, and how really it's a sort of under capitalism. Because I mean, if those businesses could pay the wages that really they should be, and market wages as they would land relative to other companies who are hiring appropriately, then they either succeed or fail, but that is capitalism.
Yeah. I think sitting here and just talking to you in this conversation, I think what we're in right now has existed from the beginning of the formation of this country, right? Immigrants come in, getting the raw deal as far as wages, whether they're paid or whether they're not paid.
It has,
and
absolutely.
it's something.
It's not a reason to not address it.
So it's a bigger problem that obviously we can fix.
Yeah.
I love the conversation.
Yeah, me too. Well, I think it can be fixed through policies where there is, we've been talking about credit card caps. We do have limits on immigration too. It's just that when people come illegally, we don't have any way to track them. We don't know for certain how many are here. We have some idea because the technology has allowed us through drones and other ways of detection to get a sense. And we know about how many are in certain sectors of the workforce at any given time. But still, it's a sketchy kind of tracking because there is no documentation in a lot of cases. Well, we've covered a lot. Thanks so much for helping me understand better, the credit card debate. That one, like I said, has been on my mind. And it's been fascinating to just listen to different people, depending upon whether you're a banker or, you're just an employee trying to understand this, or a business owner, how everybody's looking at it, but it's pretty fascinating. Same thing with the Trump baby fund. So I know we covered a lot. Chairman Powell is his tenure is up in May, correct?
Yeah, that's when the new chair should come in. But you have to remember with Chairman Powell, there's an option where he resigned. Well, his term as chair is over, but he could still be on the board of governors. There's so much inside of that.
Oh, that's true. That's true. Yeah.
I mean,
So he's still going to be able to exact some.
he probably won't. Well, I can't say what anyone probably will or won't do in this world nowadays, but I don't think the precedent is that.
We live in strange times.
Right. I mean, the guy that they appointed temporarily resigned from his other office in the White House in the cabinet so he can stay on. So I think he's going to stay on, and if depending on what Powell does is going to be what he's going to move. Update on that. I think they're going to go through the confirmation process, but Tillis won't let them bring it to a vote. I think they're going to start hearing like they have to have the oral part and speaking the words. That may be something I think they agreed upon that they'll start doing, but they're not going to bring it to a vote. Tom Tillis isn't going to bring it to a vote until they figure out what they're doing with Jay Powell. And they also may move that Jay Powell intervention to the Treasury, not the Treasury, to the Senate, the Bank Finance Committee to review versus the DOJ. So we'll see if Walsh is even confirmed come May.
Oh, that's interesting because I mean, weren't they investigating him at some point, or Trump wanted to investigate Powell for something?
The DOJ is investigating him right now for the testimony he made to the Finance Committee and just in his handling of the reconstruction or the rebuilding of the building, the Federal Reserve building over there. And Tom Tillis down here in North Carolina said he won't vote to move any nominee forward. And Kevin Walsh is interested. I think his nomination might have been brought about by Chuck Schumer. Originally when he was on the board of governors. So it just tells you, and he was like a unanimous selection. So it just tells you like where the world has come, how we are now. Which is another reason why I say it's going to be hard for us to solve immigration and all these other problems because we kept people.
It's a big issue. It's complex.
In some way, it works in bipartisan.
I agree. With that, we agree on for sure. Yeah.
It has to be partisan.
And we've got to get back to a place both in our conversations, our discourse and rhetoric, and where we are trying to come to some kind of consensus and compromise. I feel like, it's been too long now where we're in our silos and we're dug in, and that's hurting the country. So I couldn't agree with you more, Marcus, that it's fine for us to disagree, agree, whatever on the issues, the minor details. But at the end of the day, everybody has to give a little of something they want in order for everyone to benefit. And that's what we have to get back to. The common good is always what I'm interested in, even if I have to sacrifice a little bit of something for that to happen for somebody else. And I know you feel the same.
It's compromise. Yeah, but there are a lot of people who don't feel that way at all, though. There's some people who just feel like,
right.
And but that's what makes America good. Like that we have different type of people who feel different type of ways. And it was at its best when we could have the conversations.
Absolutely. Absolutely. And it's good that you and I can do what we're doing right now without fear of reprise.
Right. Right.
Yeah, absolutely. At the end of the day, those are extremely important rights and protections that we have. Great way to end the conversation because it's always educational listening to you. And I always learn a lot. I hope our listeners and viewers enjoyed the conversation as well. Folks, we'll see you back again, probably here in March. We do this monthly. So Marcus, thanks again for your commitment to the show. I love having you on, and be sure to look for Marcus on LinkedIn. He's very active on there, and his YouTube channel. So, all right, Marcus, we'll wrap it up. Have a good weekend. Take your wife out for Valentine's Day.
Well, yeah, I guess I should do that. Thanks, Christy. Thanks for reminding me. Yeah, I probably should do something for Valentine's Day. I love you, Brittany. There you go.
All right. Have a good one. We'll see you all later.
You spent the last few hours with us, navigating the transition from a world at peace to a global economy under the pressures of war. We've looked at the war room data, we've analyzed the macro shifts, and we sat down at the kitchen table to discuss the policy tools that matters to your family. This was the February pivot, but as we know, the economic fog doesn't lift overnight, it deepens. Before we close the ledger on today's briefing, I need you to take action. If you found value in this deep dive, if you appreciate a financial approach who gives you the truth without the hype, then subscribe to the Main Street Meets Wall Street podcast and Mark Sturdivant Sr.'s YouTube channel right now. Hit that like button, and more importantly, leave a comment. I don't just check the comments, I personally monitor and answer them. We're building the series in real time based on the questions you're asking. Your engagement is the fuel that keeps the platform independent and focused on the everyday investor. For your 1,300 of you who've already joined us at the Wall Street South Journal on LinkedIn, thank you. You are the vanguard of this movement to democratize institutional intelligence. If you aren't there yet, join us. This is where we turn these hours of audio and video into the charts and reports you need for your portfolio. Remember their initial barrage of data. We're dropping March, focusing on the day the world changed, the closure of the Strait of Hormuz, and $120 a barrel oil reality. And then the next day or later, we'll be releasing April's with April Systematic Risk Update. Tackling food security, higher for longer, reality for the Federal Reserve, possible issues with the Strait of Taiwan. Oh, and in between these, we have quite some market calls. We'll see how they work out. Some for the market to go down 10%. That happened. We'll see if we got any more right. This is the definitive economic record of our time. We'll be here with a new Main Street briefing every single month until this conflict concludes and the fog finally clears. I'm Sturdivant Sr. Thank you for your time. Thank you for your trust. And thank you for being a part of the ABC Squared community. Headlines provide the noise, but the ledger provides the truth. Stay grounded. We'll see you tomorrow.